Uncertainty has become part of our everyday lives. Europe is navigating an increasingly uncertain economic environment, much of it shaped by forces beyond our borders. From trade tensions and geopolitical conflicts to energy shock and shifts in global supply chains. These forces test our growth model, our resilience, and our stability. At the same time, new technologies are reshaping our economies. Innovation, not to mention AI, is becoming central to global growth. And today, the links between technology, economic power, and the international order are tighter than ever. In a fragmented world, the cost of falling behind is high. The key question is whether Europe can act decisively on its long-standing structural challenges. Not in response to a crisis, but by choice. Europe's potential is vast. Unlocking it requires reforms and a willingness to turn opportunity into action. These are the main questions we will address at the ECB Forum in Sintra. Policymakers, central bankers, and leading academics will come together to discuss how Europe can shape its future through innovation, growth, and stability.
Good morning, everybody, and welcome to the ECB Forum on Central Banking in Sintra. We're looking forward to a day or 2 days full of interesting and thought-provoking discussions. Before I hand over the floor to our moderator, I'd just like to clarify our media policy, which is quite simple. Everything that is happening on stage will be live streamed and is therefore open for reporting and quotation. Everything that happens on the sidelines of the conference, be it during coffee breaks, private discussions here in the room, lunches, is strictly off the record. And with that, I wish everybody a great forum, and I hand over to Claire, our moderator. Claire, please.
Hello. My name is Claire Jones. I am the US Economics Editor of the Financial Times. And ladies and gentlemen, it is my pleasure to be your moderator for the 2026 edition of the ECB's Forum on Central Banking. The theme of this year's forum is shaping Europe's future, innovation, growth, and stability. The ECB and other central banks have to maintain price stability amid tremendous change. Tech innovation, as we all know, is advancing at breakneck speed. Traditional areas of strength, such as manufacturing, have been hit by global trade shocks. The financial system, meanwhile, is in flux, while labour markets are being reshaped by migration, demographics, and technology. Over the next 2 days, we will hear from leading academics, central bankers, and other policymakers as they wrestle with these topics. Our first session will be chaired by Boris Vujčić, Vice President of the ECB. The second by Frank Elderson, a member of the Executive Board. Mr. Vujčić, it's now my pleasure to hand over to you. Thank you.
So, good morning. Welcome to the first session, which deals with the first part of the theme of this conference, and that's the innovation and growth. Since the productivity slowdown in Europe, which was a long time ago, 20 years or so, this has been one of the main topics, so it's nothing new. We have seen that the growth literature has established two important factors of growth. One is innovation, churning out the new technologies. The other one is the diffusion of the existing technologies. Both of those hinge to a large extent on the intangible capital, which on one hand is a direct source of productivity growth, and on the other is a complementary input into making the tangible investments and R&D translate into the productivity growth. And today, with the artificial intelligence, this framework is coming to a new testing ground. And we have two excellent experts here to lead us through the topic. One will present the paper, Bart. It's a long paper, 82 pages, but Bart has promised to keep it within 20 minutes that he has allocated. Bart is a professor of productivity studies at Alliance Manchester Business School at the University of Manchester and the managing director of the Productivity Institute. And his discussant today is Monika Schnitzer, who holds the chair for comparative economics at the Ludwig Maximilian University of Munich and is chair of the German Council of Economic Experts. So 20 minutes, Bart, 10 minutes, Monika. Bart, please start.
Good morning. Thank you. It's a great honor to speak at this forum on the topic of innovation, diffusion, and productivity. Clearly, a timely topic, given the renewed, it's moving fast, given the renewed emphasis on industrial policy in Europe and beyond, but also our shared concern about the long tail of firms that are slow to adopt to new technologies and improve their performance. The specific question I've been asked to address on is whether Europe's productivity problem is mainly one of too little frontier innovation or too little diffusion of technology. When you get a question like that, a paper gets long. I'm sorry about that, because perhaps not surprisingly, Europe needs to do better on both. Prioritizing one over the other would be a mistake, because the pace of technological change and the slowdown in globalization is now so significant that Europe cannot assume that it can simply rely on frontier technologies developed elsewhere and then catch up through better diffusion at home. Yet, that's not the main point of this paper. The deeper problem is that innovation and diffusion are not properly connected in Europe. Rather than a choice between innovation and diffusion, the challenge is to better connect them again. And that's why this paper is called Rewiring Europe's Productivity Framework. And I argue that the challenge is not just an economic one, which was the easier part of this paper, but also an institutional and perhaps a political one, which was the more difficult part of this paper. So I will make 4 points. First, Europe's productivity gap with the United States has further widened in recent years. And that matters because productivity compounds over time, so small differences can lead to sizable gaps. Second, the gap with the US is not mainly about Europe being in the wrong sectors. It is mostly about weaker productivity growth within sectors across the economy. Third, innovation only raises productivity when firms can scale, commercialize, adopt, and absorb new technologies effectively. And finally, the key implication of all is this, that we need to increasingly focus ourselves on the role of intangible assets, as the chair has already mentioned, and the associated capabilities that firms need to use them well. So let me start with some basic facts. The United States has recently pulled further ahead of Europe by adding $14 of GDP per hour worked in real terms between 2018 and 2025. The euro area only added about $2 over the same period. And that means that the productivity gap between Europe and the US has widened from around $9 per hour in 2018 to $21 in 2025. Now, some of you will immediately say, I heard about this debate recently, a long-standing debate that resurfaced on how Europe compares to the United States, prompted by interventions from Paul Krugman and responses from Philippe Aguillon and others. Now, part of this argument is about technicalities. How should we compare levels and growth rates of output and income and productivity across countries? And I will not dwell on those issues now, as the focus here on the left-hand chart is on a relatively short period of 7 years, and that limits this technical concern. But part of it is also more substantive. How should we weigh productivity against broader measures of welfare and living standards? And at the end of my talk, I will briefly return to those broader issues. But looking at the right-hand charts, which adopts a longer time frame, but only time series, it is clear that there recently has been an impressive acceleration in US labor productivity growth, whereas the euro area as a whole has not returned to its already modest pre-pandemic productivity growth trend. The next question is, what explains that recent widening of the growth gap? Is Europe structurally specialized in what today may be the wrong sectors? But the chart really suggests that that is not the main story. When we use detailed data here of 57 market sector industries, and we decompose productivity growth between the euro area and the US, it shows that less than 1/5 of the productivity growth gap is explained by industry structure, whereas the bulk of the gap reflects faster productivity growth within industries in the United States. On the right-hand side, you can see that the digital sector matters a great deal. While it accounts for a relatively small share of value added, about 12% in the US and 8% in the euro area, it explains more than 1/3 of the overall productivity gap between the euro area and the US. Digital services are especially striking, as productivity growth in computer programming and information services has increased on average by about 10% a year in the US, compared to only about 1.5% in the euro area. But, and this is important, the gap is not only a digital sector story. The US also performs better in ordinary market services, wholesale and retail, professional services, administrative support, which are much larger sectors. And that means that the policy question is not just simply on how to create more high-tech sectors. It is how to raise productivity within the sectors, and especially to reduce the well-documented large productivity gaps between leading and lagging firms in each sector of the economy. That brings me to the core theme of this paper, the link between innovation and diffusion and productivity. A lot of this is well established in the literature, but Europe's challenge requires us to look more closely at the innovation process. For starters, Europe's principal weakness is not the generation of knowledge or invention itself. In many fields, Europe is at or close to the global scientific frontier. There is a substantial patent base, albeit it is fragmented and still has a strong home bias, as Anthony Bergeau, in his paper 2 years ago, right here, has argued. And while Europe does have a weakness in R&D intensity, as Daniel Gross and others have shown, that weakness is concentrated in only a few sectors of the economy, and it does not spread evenly across the economy. The evidence, therefore, does not support the simple claim that Europe lacks innovation. The bigger challenge lies in the red arrows in this chart. First, commercialization is constrained by fragmented capital markets, weaker scale-up finance, and insufficient cross-country coordination in public procurement and standards. An incomplete single market not only limits downstream diffusion, but it also weakens early market demand signals and therefore reduces the opportunities for firms to scale across borders. Second, dissemination of technologies is slowed by underskilled national innovation institutions and weak coordination between public and private investment. But particularly here, regulatory fragmentation and market rigidities reduce competition and weaken business dynamism, which prevents new technologies from spreading quickly across firms, sectors, and national markets. A third critical area are the weak feedback loops, which impact on the system characteristics of innovation. Market signals do not get translated quickly enough into commercialization decisions, and therefore they lead to a misallocation in innovation funding. And Europe also struggles to build cross-border supply chains or implement missions that genuinely pull innovations through into markets. Finally, on the right-hand side, adoption happens inside firms, where technologies are put to work, but firms need absorptive capacity, such as skills and management capabilities and data and finance and organizational capabilities. And this is a major challenge in Europe because many firms remain small and quite often are under-resourced to absorb and scale new technologies quickly. Artificial intelligence is perhaps the clearest example of the critical connection between innovation and diffusion. First, AI is not just a general purpose technology, which is widely applicable, potentially transformative, and relevant across many sectors. I think we all agree on that already. It may, however, also improve the methods of invention itself by supporting research, idea generation, and experimentation. This way, AI would not only raise the level of productivity, but it could potentially also change the productivity growth rate on a more permanent basis, although this, of course, still remains to be seen. The United States is clearly advanced in capturing those upstream productivity benefits from AI software creation. For example, recent estimates by Bontadini et al. Suggest that upstream AI software accounts for roughly 40% of the acceleration in US productivity growth, which accelerated by 0.5% a year between the mid-2010s and the beginning of this decade. Europe's upstream position in AI is much weaker, so it is less able to benefit from this invention in the method of invention channel. On adoption, however, interestingly, the EU-US contrast is less decisive. Official surveys suggest that AI adoption by firms is growing rapidly, but it's still relatively low compared to its perceived transformational potential. Perhaps at most in the high teens or the low 20s on both sides of the Atlantic, and that really then also depends on the definition. So 2 points follow. First, Europe may not dominate in foundation models or frontier compute, but much of the productivity value may come from applications in sectors where Europe has strengths: manufacturing, health, professional services, perhaps even public services. Second, AI illustrates what may be called productivity leakage. Task-level gains, which are very obvious, do not automatically become firm or sector or economy-wide gains. They have to pass through business innovation processes. And that brings me to the investment side of this story. If AI and other technologies are to translate into productivity, firms need complementary intangible assets. These are investments that reduce that leakage between what the earlier diagram showed as potential versus realized absorptive capacity. These investments include technology-related assets, but also business innovation-related assets, such as organization and management and branding, design, and firm-specific skills. Recent estimates by WIPO, which cover the EU as well as other major economies, show that tech assets, such as R&D and software and databases, are growing the fastest, which you can see on the left-hand side. But organizational capital, which you can see on the right-hand side, accounts for the largest share of total intangible investment. So Europe's productivity challenge depends on getting technology-related intangibles work better together with business innovation intangibles. So how do these intangible investments then translate into productivity growth? A growth accounting decomposition suggests that intangible capital deepening, which are the green parts of the bars here, has increased both in the United States and across the EU countries, comparing pre- and post-financial crisis periods, although the contribution of intangible assets remains substantially larger in the United States. At the same time, stronger intangible investment has not been sufficient to offset the post-financial crisis decline in tangible capital deepening, so the blue parts of the bar. So while intangibles become increasingly important, their returns have not been high enough to compensate fully for the higher depreciation rates relative to tangible assets. But the central message of this chart is that once intangibles are included, the slowdown in EU labor productivity growth is not mainly explained by weaker capital deepening, but by weaker TFP growth, the purple part of the bars. And that means that the claim that Europe's productivity slowdown is primarily the result of too little investment is at least incomplete. A call for Europe to invest more means that we need to focus on the right mix of assets and the capabilities which turn investments into productivity. So, what does this then mean for policy? Let's start close to home with monetary policy. And the key thing I'd like to pick up here is that as economies become more intangible intensive, traditional credit and collateral channels tend to weaken. Lower collateral value may put downward pressure on the equilibrium interest rate. But as Jonathan Askell has argued, credible expectations of intangible-led productivity gains can support current demand and investment, and that may push the equilibrium rate upwards instead. But then if diffusion remains weak, as this paper observes, monetary policy may simply dampen investment without the offsetting expectation of stronger future productivity growth. My other policy remarks relate to Europe's fiscal and structural policy framework. First, Europe needs to rethink how it structures its vertical and horizontal policies for innovation and diffusion. Vertical industrial policies can help build scale in strategic areas, such as clean technologies and defense and advanced manufacturing. But they raise productivity only when linked to horizontal policies, such as competition and trade and fully integrated labor capital and product markets, as well as skills and labor mobility. Vertical policies without horizontal policies can create concentration without diffusion. Horizontal policies without strategic direction may support adoption, but not necessarily create the scale and the feedback loops needed to strengthen the frontier. So again, we need both to reinforce one another. And that's hard in Europe because the relevant policy levers sit at different levels of government. Competition, trade, market integration, and many regulatory powers have traditionally been at EU level, while skills and SME support and local infrastructure and innovation policies have mainly been national or quite often even regional. But these responsibilities are now shifting. Right? In response to the Draghi and Letta reports, the Commission is moving into areas of industrial strategy that member states have long regarded as largely within their own remit. The proposed EU Competitiveness Fund and the Industrial Accelerator Act are good examples of this shift from coordination and framework setting towards a more active EU role in steering investment policies. And that raises important governance questions. EU-level primacy makes sense where scale and cross-border spillovers matter, but only if governed by clear principles of competition, transparency, and accountability. And at the same time, national and regional policy should focus on diffusion and strengthening absorptive capacity of firms. National productivity boards could help connect these levels by identifying bottlenecks, sharing lessons across countries and regions, and keep the national productivity agenda focused over time. Let me then briefly return before closing to Europe's comparative performance relative to the United States. As mentioned, part of that debate is technical on how we compare levels of output and income and productivity and growth rates across countries. But another part is substantive, how productivity relates to welfare and living standards. Output per hour and total effective productivity remain essential measures of economic performance, but they do not capture everything we may want to know about the purpose and effects of innovation and diffusion. One way to frame productivity, as we do at the Productivity Institute, is as the capacity of an economy to use its limited resources more effectively to improve outcomes, not only for firms, but also for people and for places. And that matters because innovation can widen gaps before diffusion is going to narrow them. And regional evidence illustrates this clearly. Europe has strong productivity hubs alongside regions that are caught up in persistent productivity traps. With this broader definition, productivity gets an important inclusion dimension. It means widening the access to the sources of productivity growth, and it means strengthening the transformation process through competition, through business dynamism, and better labor market matching. And it also means that productivity gains need to land more broadly to sustain economic and political support. This broader productivity framework also extends output beyond GDP towards welfare and well-being, which has been a big field of research since the Stiglitz report of 2008 until the recent UN report on counting beyond GDP. But looking at productivity, that also means we have to extend inputs beyond labor and physical and even intangible capital to include assets such as human, natural, and social capital. And these latter assets are closely linked to the ways innovation and diffusion shape economic performance and help connect productivity more clearly to living standards and resilience. In closing, this is what I mean by rewiring Europe's productivity framework. The task is not to choose between frontier innovation and diffusion, but to connect them through stronger capabilities, better institution, and clearer governance. Europe needs to invest in the assets that reduce productivity leakage as technologies move from invention to adoption and scale. And it needs to combine EU-level scale where it matters with national and regional capacities to ensure that innovation and diffusion translate into productivity gains for firms, for places, and for people. Thank you very much.
Thank you, Bart. Well within 20 minutes. And now I give floor to Monika.
So thank you very much, Bart, for this very interesting and important paper. And let me start by saying that I very much agree with your basic diagnosis. Europe's productivity problem is not simply a story of too little innovation at the frontier or too slow diffusion. It's a combination of the two. This is, in my view, the central strength of the paper. It forces us to think about productivity as a system of ingredients that have to work together. In my comments, I will ask what artificial intelligence will do to the system and what it will take to boost European productivity. Why focus on AI? Because AI is the most important test case for whether Europe can get the opportunities that AI offers right. As the slide shows, estimates of the productivity effect differ widely. For the US, they range from very modest effects of 0.07 percentage points to much larger effects of 0.7 percentage points of TFP growth. For Europe, the estimates are closer to 0.2 to 0.3 percentage points. If we get AI wrong, this technology will not narrow the gap. It will widen it. Bart's paper shows that the disappointing productivity growth in Europe is not mainly because Europe has the wrong sectoral structure and the US has the right one. The important insight is that the US has achieved stronger productivity growth within industries. That's why the question on the slide is not only how much AI will raise productivity in general, but whether Europe has the diffusion capacity and the upstream base to benefit from it. So that's crucial for the AI debate, because we need to ask whether AI can raise productivity across sectors in which Europe already operates: manufacturing, professional services, logistics, finance, healthcare, many others. Which brings me to the 4 challenges on the next slide, and I will go about them in turn. The first challenge is compute and energy. AI needs data centers. It needs chips, electricity, grids, capital, and more. Compute has become a strategic input, and at the moment, Europe is not well positioned. As the slide shows, Europe hosts only around 5% of global AI compute, but to match Europe's economic weight, this would have to be closer to 20%, and part of it should be under sovereign control. There's a very practical reason for that. If European firms build their AI applications, their data infrastructure, their business models on foreign infrastructure, then a substantial part of Europe's future productivity potential depends on decisions taken elsewhere, on pricing decisions, access decisions, export control decisions, the legal jurisdictions outside Europe. So compute determines whether firms can reliably invest in AI applications. Sovereign compute determines whether sensitive applications in areas such as defense, tax administrations, or critical infrastructure can be developed under European control. But compute raises a second issue. Data centers need enormous amounts of electricity, and they need it reliably. If Europe wants more AI compute, it also needs faster grid expansion, more energy supply, suitable locations, and much faster permitting. So my first point is Europe needs more compute, and at least part of that compute should be sovereignly controlled. So the second challenge is access to frontier technology. At the moment, the most powerful AI models are developed mainly in the United States. European firms, universities, public administrations rely heavily on this access to these models. We should use it, but we should be aware that access can be restricted. The point of the example on the slide is precisely this. Access to frontier models is not guaranteed. It can be repriced, it can be conditioned. For firms, this matters enormously. Their investment in new processes and business models can only make sense if access to the underlying technology is reasonably predictable. If it's interrupted in the middle of the installation phase or token prices rise sharply, the productivity J-curve may be cut off before the gains even arrive. So what follows from this? Europe needs a two-pronged strategy. First, we should secure access to the best global frontier models through contractual, commercial, and diplomatic means. We should not pretend that Europe can immediately replicate the entire US frontier. That would be neither credible nor necessary. Second, Europe needs its own frontier capacities for sensitive and strategic applications where sovereignty, security, or public trust matters. Here, Europe is not without leverage. We have strategic assets in the global technology stack like ASML, ZEISS, and others. Europe should think more strategically about how these assets can support reciprocal access, security of supply, and bargaining power. So my second point is Europe should remain open to US frontier models, but it should not be naive about dependence. Secure access and European strategic capacity have to go together. Now, the third challenge is process efficiency. AI can help firms do what they already do faster, cheaper, better. Things like support customer services, software development, legal analysis, and many other tasks. But we have to distinguish very clearly between adoption and transformation. It's one thing for firms to use ChatGPT or Copilot occasionally. It's quite another thing to integrate AI into core processes. Only if this works out, we can expect a macroeconomically relevant productivity boost. So the slide makes this distinction very clear. In the euro area, about 70% of firms report some adoption of AI, but only 7% report intensive use. That's exactly the problem. If AI is only used to save time on individual tasks, while the workflow around these tasks remain unchanged, then the productivity gain will be much smaller than possible. So to generate productivity growth, AI has to be combined with complementary assets, and very importantly, firms need to reorganize their processes. So my third point is we should not measure success by whether firms use AI. We should measure success by whether firms use AI intensively enough to redesign core processes and raise productivity. Now, the fourth challenge is new products and services, and this is often underemphasized in the European debate, but it may be its most important point. The largest growth effects from AI will probably not come from doing things a little more efficiently. They will come from creating new products, new services, new business models, innovations that create new markets, new value chains, and possibly entirely new industries. This is where the comparison with the United States becomes particularly important. The US is not only ahead in using AI tools, it's ahead in translating AI into new firms, scalable products, and large business models. Now, this has to do with risk capital, with a large unified home market, with better scaling opportunities, and with direct access to compute and frontier models. So Europe's risk is that we use AI mainly to optimize the present, while others use it to build the future. This is why the product innovation agenda is so important. As the slide shows, only 34% of firms currently use AI to create new products and new business models. And the financing gap is enormous. The US attracts 75% of global AI venture capital in the last year. The EU 27, only 6%. Europe needs more risk capital. It needs regulatory experimentation. It needs a truly integrated digital market. fragmentation reduces scale, incentives to invest, innovation, and ultimately productivity growth. So my fourth point is Europe should not be satisfied with AI as an efficiency tool. We need AI to develop new products, new services, and better business models. So let me conclude with one additional point. Realizing productivity gains requires involving society early on. In its current leader, The Economist has warned about the AI backlash that's building up, at this point mostly in the US. If workers experience AI as a tool for surveillance or replacement, the political backlash will be serious. It's therefore important to understand that AI policy is not only innovation policy, it's labor market and social policy. So my conclusion is this. Bart is right. Europe's productivity challenge is a challenge of investment, innovation, and diffusion. AI makes this challenge more urgent. It's the technology that will test whether Europe can finally connect these elements. If we fail, we risk falling more behind than ever. Is Europe on the right track? Not yet, but we can still get there. I think it's up to us. Thank you.
Thank you, Monika. So let me turn first to Bart, if you want to react to the discussion before we go to the audience.
There's this expression that we violently agree, and I think we do. So you always have to look for some of the differences here. I appreciate the focus on AI, as I spent quite a bit of time on it myself in the paper and in my presentation. But I'll also challenge things a little bit and say maybe, certainly when it comes to the frontier innovation part, maybe the AI battle to a large extent is already lost, and that may not be our primary area of focus. I think we are in need of a frontier innovation system that looks for the new opportunities, which can be in clean tech or in defense or in security, where, by the way, AI can play a critical role to facilitate these kind of new technologies. But I think one thing that I would perhaps emphasize is not to overly focus just on AI as being the thing now. The invention, the method of invention characteristic is an important one, and it can drive research and scientific breakthroughs in other key areas of technology. So that would be my main comment, perhaps provoking a little bit more discussion around this.
Thank you. We're open for questions now. So who's going to start? Will here, and then Jeroen and Alvaro.
Thank you, Volker Wieland, Goethe University. One question to Bart. I think it was fascinating to look at this data and how to understand productivity. But if you were asked, what are your top 3 recommendations for national governments or for the European Commission, what would those be? And to Monika, I think it was very instructive, the focus on AI. You mentioned at some point we need X% sovereign control. It seems to me this could be understood 2 different ways. One is to have private companies build up compute and in Europe under European jurisdiction, maybe European companies, versus basically the government doing this. And you know, how did you mean it? I'm a bit skeptical if the government has to do it, because if I look, at least in Germany, at the administrative digitalization, you know, it's slow.
Jeroen, if you can just pass.
Hi. Does this work? Yeah. Jeroen Zettelmeier, Bruegel. Thank you. Fantastic presentations. 2 questions for Bart. The first is your initial result that we are not in the wrong sectors, but it's about the activities within the sectors and how we do them. How sensitive is it to how you define the sector? So it applies for broad sectors, but as you get more granular, does the result go away at some point? And then the second question is a bit along the lines of Volker. Can you elaborate on your point about division of labor between the EU level and the national level? So I wasn't completely sure whether what you're arguing is effectively that we should go back to the basics, to the original paradigm where the EU was supposed to, you know, make sure that there's a single market that works as much as possible, trade policy, competition policy, everything else is member states, and very tight state aid control, versus some of the nonsense that's going on right now? So are you mainly criticizing the current nonsense, or is this about a completely new paradigm?
Thank you. And the last question for the first round, Laura.
Thank you very much. I think it was fascinating discussion, and I think great paper, by the way. Just first of all, on your comment that the battle is lost for AI, well, it might be, but remember that for Europe, but remember that DeepMind was European and it went to the United States. I'm not saying that it's good or bad. What I'm saying is that over a few decades, we had quite a few major industries and firms that decided not to stay in Europe, and they went to the United States. So it would be interesting to know why that happens. Second, I really like the part that you talk about frontier regions and productivity hubs, but also again we have the same thing in the United States. We have Silicon Valley, we have New York, but you know in a few other spots. But we also have laggard and peripheral regions in Europe. So the question is why in Europe these peripheral, the frontier firms do not have a bigger impact on the peripheral region, and why isn't there more convergence across Europe? But I think this is quite important for you. And productivity hubs, of course, they're not static. When you look at Ireland, 30 years ago, nobody would thought that Ireland would be where it is. And so I think it's important to put this in perspective. Yeah. Second, focus on intangibles. The banking sector, we know that in Europe, the sector is much more banking based than in the United States. Do you think this is part of the problem? We know that intangibles have a 20-30, investment intangibles has 20 to 30% depreciation rates. So that's why sometimes banks are reluctant to finance. We see a lot of private credit in Europe and the United States. And so the question is whether you think that changing the financing system is crucial for us to get more investment. And of course, I think savings and investment units like in Germany, the pension reforms like in Germany are crucial for us to do more. You mentioned last thing, you mentioned something on productivity boards, which I totally agree with you, okay? I really like productivity boards. The problem is that in Europe right now, productivity boards are extremely limited, badly resourced, zero impact almost, okay? And so the question is, how can we, as Europeans, make sure that these productivity boards have an impact, and allow us to have more innovation in Europe? Thanks.
Thank you. So, Bart, first.
Sure. Let me take the first question last, because it's basically the three major insights or things to take forward I would take. But let me first go to the second and third question, then come back to you. Your point on the fact that if we go more granular, that we would then pick up more sector rather than within sector, between sector rather than within sector, is of course right. The more granular we go, we'll see more differences, and therefore sector become more important. Of course, this was already 57 industries, which is more than what the official metrics can do. We had to actually work quite hard to get to this level. So we're already picking up a lot of sector effects. I think if we go more detailed, we'll pick up a little bit more of that. That's fair enough. But it will never not switch. That's my main point, the fact that within sector is, and that between firm is so important. So I think we have to pick that up as being very important. You asked me to elaborate on the policy issue. It was exactly the second point that I want to make. The point that I'm really trying to make is that there is no other choice at the moment than if we are going to focus more on digital strategy and digital policy, and I think that is a given the challenges that we're facing, then you have to think about where should EU primacy be. And then as I argued, I think given scale and cross-border spillovers, it makes sense to do that at a European level. I think, however, there are huge risks with that, as industrial policy always has huge risks. And therefore, I would argue very strongly in favor of putting that industrial policy a little bit more at arm's length of the Commission. I think it is unusually close to the Commission itself. If you want to have clear accountability and transparency, it probably needs to be a little bit further away from the Commission. So I think the challenge is that the governance that we are used to is actually being challenged and almost like swapped around, right? Where, historically, national governments, national science foundations will be driving still a lot more of the research and innovation process than the European horizon. What we're now seeing is that with the European Competitiveness Fund, actually a big part of the funding for the European Competitiveness Fund goes to the Horizon Research Project, right? I'm submitting a Horizon Research Project, and the requirement is that we have to fit into the industrial strategy. And so that's all at the European level. National science foundations still do their own thing. They're not yet joining up resources to make sure that we create that scale. May I pick up the national productivity boards thing, Alvaro, that you raised, because I think it's really important. Dirk Pilat and I did a lot of work on comparing national productivity commissions across the OECD, and you're absolutely right that national productivity boards, which is a European mandate, are very weakly resourced in Europe. Most national productivity boards have just a few people who may be doing some research, and then they sort of engage with policymakers and with government. If you take the Australian Productivity Commission, which is the most well-established, well, that's a huge one that actually has 100 people, but there are things in between there as well. So I think if we want national productivity boards to really take charge of the national productivity agenda, they need to be significantly better resourced, and this is currently the case. So I totally accept that point. Let me just make sure that I pick up. My notes are not great, actually. Frontier firms versus absorptive capacity. So I think that link is quite important. That we're making sure that again the link between frontier firms and absorptive capacity are properly made. The new banking sector issue, very important. One issue with intangible assets, as I said, they're very low depreciation rates, very high depreciation rates. So you can fail fast, right? And banking sectors find that very difficult, whereas venture capital and other risk-specific capital allows you to invest more quickly in intangible capital, not be as such concerned about the collateral part, but also move on very quickly if these inventions don't give you the kind of returns. Now, finally, on what are sort of the key main lessons that I would take of things to do. First of all, governments do not get obsessed about this distinction between innovation and diffusion. There is a lot going on. I would almost say, do we really need a lot more instruments than we already have to do this? Or do we need to focus on making sure that we scale them up and that we coordinate and collect them better? I think the concept of leakage is very important. The use cases in Europe when it comes to AI are as strong as they are in the US. There's no difference there. The problem is that as soon as we scale up to firm level, to sector level, to national level, we see a lot of leakage because of too many barriers standing in the way. So focus on these barriers. That's my second message. And my third is make sure that productivity doesn't only work for the limited group of firms that are already very successful, but find a broader base. This goes to my later point on the broad concept of productivity, to make sure that we also have the economic and the political support to continue this program on innovation and diffusion going forward.
Thank you. Monika.
Let me start by Volker's question about who should make sure that we have sovereign control of compute and of these capacities. It's not that the government should build it, but it should facilitate it. It should make possible that it's built in Europe, because it's already really important to have it on European ground. Then you have much more leverage over it. So the government can help finding sites. Old industrial sites with a good connection to the electricity grid, for instance, is very important. And then facilitate that energy is available. And then make phone calls. Macron made phone calls to Silicon Valley and made sure, or to other companies made sure that they actually come in. And Rishi Sunak made phone calls to Silicon Valley talents to bring them to the UK AI security institutes. I mean, this kind of political intervention is needed. And then the rest can be built by private capital. Absolutely should, because otherwise it's much too expensive. So let me also comment on a couple of the other points. Why do firms move to the US? I think we mentioned it already. We have too little venture capital. We have not a unified market. So in order to scale, the US is much more attractive. At the same time, I think another issue is that in politics, we focus too little on these small firms. Now, perhaps I speak only for Germany now, because here I know the political debate very much. And we focus a lot on the large companies, and we are very concerned if they lay off people, and that's, of course, a big concern. But we have not enough new young companies that really scale up and then take over and become at one point the leading industry, and that's what we need. So what we also need then is consolidation. You mentioned the banking industry. Again, I won't name the names of the banks, but we know Italy and Germany are now in a discussion whether we should have bank consolidation. So should it be Rome that decides who gets a credit in Swabia? I think, well, let's put it like this. I don't see an issue here. I think we need more efficiency by having more consolidation. And the same thing is true for a lot of the small companies. I mean, this is the issue that you pointed out. We have these laggards. We are very proud, again, in Germany, of our small, medium-sized companies, but we need them to grow and to become more efficient. And if you hold this back by letting them do whatever they do and protect them, that's not working. And what I really find problematic is that in the end, we also relate this then to cultural issues. So Germans, I heard, don't like automated driving because they want to be in control. I mean, with the gear shift, So why don't we have more automated? Once we have it, we will love it. I definitely look forward to it when I'm a bit older. And the same thing with cash. I mean, in Togo, I heard you can give direct subsidies to the people by using their phone. In Germany, we say we still need cash because we want to be in control. So in the end, I don't think we are so culturally different in Germany. We simply don't provide the means to move ahead.
May I briefly react on the last point, because I think it's critical on how we actually take the workforce along in these new projects. I mean, I looked at some of the work in the papers. I think it will also come back this afternoon, probably in the discussion. The worker adoption of AI is much further advanced than the business adoption of AI. So any businesses who think, what are we going to do with AI? You know, I would say, well, why don't you start with your workers, because they're already using it, right? If you don't think they're using it, they do. And these differences are actually becoming bigger. So the issue is not that workers are reluctant to use it. The issue is that workers are not part of the journey in the business innovation process. So I was at an event with business leaders last week, and I thought, what's the most important thing for me to do to get my AI program right? Say, start taking your workers along from day one onwards, because they know probably better than yourself what they can possibly do with it, and you get much more skill out of this. Yeah.
Okay, so we won't have time for all the questions, but let's try to take first three. But first we're like Sebnem, Beatrice, and Christine. So let's take that round, and then we'll see where we are.
Thank you. Fantastic panel. Şebnem Kalemli, Oscan Brown University. I want to go back to Governor Alvaro's financing question in the banking sector. You mentioned that this is a big problem because banks are reluctant to give financing given the depreciation of the intangible capital. But why is that? I mean, if you look at the US, and we all agree that Europe has to mimic the dynamism in innovation of the US. In US, small, medium enterprises do borrow using their intangible capital as collateral. We know this from the very unique administrative data set of the Federal Reserve. And that is very, very important. That is actually the single most important thing right now underlying the explosion in the drone sector in the United States, which is also, not only like, the new patenting, new technology of the new drones integrating with the AI. And it is completely done based on the intangible capital patterns being collateral. I cannot imagine US banking sector being that different than the European banking sector. So what is the bottleneck here? Is it really a European-wide thing, or is it more about national, domestic financial frictions that we know also were responsible of the misallocation of capital in Europe before the crisis? Thank you.
Beatrice Vera Di Mauro, CEPR. Thank you also for this great discussion, very important discussion. I was very glad, Monika, that you raised the question of access, because that's something that's very, very clear now that this is going to be a topic. And we talk about AI mostly in terms of the challenges and opportunities for productivity, but what about the dangers and risks, which in fact many of the AI leaders have been emphasizing, the idea that one model wins and you do need access to it, otherwise you are at risk. How to think about that, and doesn't that make the whole story of access and productivity even more pungent? How do you think about it, Bart? Because in your view of AI, you seem to be much more in the competitive model than in this sort of danger zone. Yeah.
Better here to Christine.
Thank you. Kristen Forbes from MIT. Monika, you started with this wonderful phrase that productivity is from a system of ingredients, so not one magic bullet. Then each of you listed a long list of ingredients, but neither of you highlighted the role of labor market flexibility. So I was wondering if you could talk a bit more, why not? My understanding of the literature, and both of you alluded to this in your comments, it's not the new innovation that generally leads to productivity growth. It's the adaptation, which often leads companies to redesign how they make things, and the new companies that start up because of the innovation. And that does require labor market churn and labor market flexibility, which can be painful, but that is part of the process. So I was wondering if both of you just ran out of time, if you think this is important. If you do think it's important, what specifically would you suggest for Europe? Especially given this new technology such as AI has already created substantial angst. If labor market flexibility is part of the solution and part of the way to lead to higher productivity growth, there's going to be even more concern about supporting that given this new technology.
Okay, thank you. I have 3 more questions on my list, but I'm afraid that due to time, we'll have to stop here, and you will not have too much time to respond to these 3 that you got.
So first of all, on the intangibles financing question, which I think is a really good one. One thing that the research is showing actually on all this is that intangibles tends to be very much equity-based, and smaller firms, when they use intangibles, all from their own funding because of that difficulty to access markets. That, by the way, is also true for the US. But you are right that if companies want to go out because they want to scale up their intangible investment, it is easier in the US to actually get banking to agree there. I'm not an expert in the banking sector, but I think one critical assumption is that banks in the US are generally larger, therefore more willing to take on risk than is the case in European banks, which generally tend to be smaller. So I think that is probably one element that is creating a bottleneck here, but maybe Monika can also respond a little bit to this. On Beatrice's question on dangers and risks, I am concerned about that. I think we all are. But the question is indeed, what is the right model? And at a very high level, I would make sort of an extreme distinction between, on the one hand, the US and China, which both take a very practical approach towards regulation and safety and risks. Let things happen and then see how things are going to play out. In Europe, we have this tendency to preempt possible risks and so on. And therefore, that is actually raising the barriers for companies to try things out. I think actually, working in the UK, I think the UK has an interesting intermediate model which tries to really take an innovation-based approach to AI, try AI out in various sectors, but also track it very closely and try to respond to it with regulation if that is needed along the road. And I think that middle road is an interesting one to investigate, and I think it shows reasonably good results in the case of the UK, which, when it comes to AI, certainly on the AI frontier kind of activity, is ahead of most of the other European countries. On the labor market flexibility, it's a really good question. Because we know there is this inverse EU curve in labor market flexibility, and that is that, we all know why it works, and it is critically important. By the way, again, it's an area of policy that currently very much sits with the national government. And again, from a sort of single market perspective, that is actually one of the constraints for having people move across borders in this respect. So there's something that we need to do there as well. On the other hand, we know that there's a tipping point, and if labor market flexibility goes too far, people are actually not willing to adopt new business models and go along with the discussion that we had earlier about going along with their employer to try and sort things out, because they just feel that they can be hired and fired at any time. So why actually try and do these kind of things? So I think it is just underlining the fact that we need to find out whether the tipping point, where there's the change in the inverse U curve, whether that's been shifting over time as a result of the new technology, and whether it has to shifting to the right or to the left, and I'm not quite sure where the literature on that at the moment is.
Thank you.
2 quick reactions. First, to risk are very important. I think there are 2 risks here. The first risk is if we don't have access to the frontier models, and the AI will invent itself, and this will happen in 3 years. That's my guess. So, talking to people in the Silicon Valley, then those who have access will move ahead in a way unprecedented. So that's the technical, that's the economic risk that we are facing. And then, of course, the cyber risk. So if we don't have access to the best models to defend ourselves, but some hackers will find their way, whatever their means will be, then we are really exposed. And then I know that the ECB is already working a lot on that, but I don't think that the small Sparkasse in Baden-Württemberg is. So it really is a huge risk that we are facing. And so we definitely have to tackle that. On labor market flexibility, the problem is we have a bad equilibrium here. So people never change their job. So when they have to, if they find it hard to start a new job somewhere else. So we need to move to a new equilibrium with more moving, because this reallocation also improves productivity. People find a better match, people find a better job, and they can make better use of their resources. So this is a general problem that we are facing for a long time. But there are real impediments. The real impediment, again, I speak for Germany because I know it very well, housing. Moving means you leave your old, new, low rent house, and you now have to buy a very expensive house or apartment, a rented apartment that's much more expensive. That's an impediment. Care work. You need to care for elderly, and you need your grandparents to help you care for the children. So as long as this is not solved otherwise, a big impediment. Pensions, move your pensions from one company to another, big impediment. So we really have to change the whole system. So this all has to go together. But definitely the labor market is a huge issue. And this is why I mentioned it in the end, because I realize already the unions are already preparing for making sure this AI won't challenge their jobs. And of course, they are concerned, but we need to take them along, because otherwise we will have this backlash. And then the additional backlash is against data centers. Also, we see that in the US. So there's real concern that it will never come to fruit, what the technologies will offer. So we need to have a serious discussion on that.
Thank you. This is where we have to end this interesting discussion. I would like to thank both speakers. And with that, hand over to Frank, who will chair the next session. Thank you very much.
So, welcome to this second panel. We are very pleased. Let me first introduce the people here on stage. So we are very pleased to have Maria Assunta Gianetti presenting her paper today. She's professor of finance at the Stockholm School of Economics and one of the leading scholars in corporate finance and financial intermediations, with work that has directly informed policy debates across central banks and international institutions. And she has co-authored her paper with Cameron Ellis and Jyoti Castilla. And we are equally fortunate to have Enrico Perotti as discussant. He is professor of international finance at the University of Amsterdam and a leading expert in banking, financial regulation, and political economy, with extensive experience advising central banks and policymakers. So in terms of the substance of the paper and why it matters, and I happen to think it matters a lot, this paper makes an important distinction between, a distinction, by the way, that is often missing in the broader debate. It reminds us that regulation is not one-dimensional. It can be stringent and complex, and these two things are not the same. And this is highly relevant for us at the European Central Bank. We have been very clear that there is scope to simplify regulation and prudential supervision and to cut unnecessary rules that do not add to financial stability but are costly and time-consuming. And that is exactly what we are doing right now, making supervision more risk-based, more efficient, and more forward-looking. But, and this is crucial, simplification is not the same and must not become deregulation. And in this context, we should remind ourselves why we have regulation in the first place. Banks do not fully internalize the risks that they create for the system, and regulation is there to align private incentives with social outcomes. And the lesson from past crises show that there is no need for a choice between stability and growth. Too little regulation ultimately undermines both. We should also remember why complexity arises. It is often not accidental. It reflects the fact that financial systems are complex, but also that institutions look for ways to circumvent rules or to obtain exemptions. And regulation then adapts to that. So the key question is not whether the rule book is long, but whether its complexity serves a prudential purpose. Yes, some parts of the framework may be too cumbersome, and there is scope for reform, but simplification should not mean removing the elements that make regulation effective. And this is precisely, and I'll give you the floor in a second, really, this is precisely where the paper makes a valuable contribution. It shows that the data tell a much more nuanced story. It's not about too much regulation or too much complexity. It is about getting the balance right, ensuring that regulation is sufficiently binding and that its design makes it effective. In fact, the evidence suggests that stringent regulation works best when combined with sufficient operational detail to prevent circumvention. In other words, some complexity is not a flaw, but it makes regulation effective. And with that, let me invite Maria Santa to present her paper, and you will do so, as you promised, in 20 minutes.
Of course. So first of all, thanks a lot for having me here to share my thoughts on bank regulation. The paper is developed with Fabio Tikashira and Cameron Ellis. So the current debate, both academically and in policy, about regulation is largely surrounding Basel III. What has Basel III done? First of all, it was introduced after the global financial crisis and was addressing concerns that, well, risk weights were not enough to constrain reshifting. So we introduced a lot of new targets for bank regulations: leverage ratio, liquidity, LCR and SFR, and so on. What does current literature tell us? Well, most of the papers, and I am citing here one, tell us that these many targets could lead to misallocation and that complexity might be too high. And informed to some extent by this debate, currently in different jurisdictions, there are various adaptations of Basel III. The US is going towards loosening the regulations. Europe is mostly simplifying. Switzerland, that experienced a major bank failure with Credit Suisse, is tightening. So the trade-off between stability and growth is generally attributed to the stringency of regulation. And common wisdom is that having a more stringent regulation will reduce growth. Typically, complexity is considered just as a deadweight loss. Why? Well, it increases banks' operating cost. The view that I want to share today is I want to examine the hypothesis and offer to you some empirical evidence that actually complexity might be, in some circumstances,
something that we need because markets are developing and becoming increasingly more complex in a way that regulation has to have many targets to be effective. Again, let's go back to what we can infer from current literature. I would say that the current literature has a very negative take on regulations and especially complexity. In particular, in the literature, in the political economy of financial cycles, many, and I'm talking about an AR paper, have highlighted that sometimes after a financial crisis, policymakers and regulators are want to show competence and want to do something. And these complex, not so well-tailored regulations can be just something that is developed in a rush. However, there are also dissenting voices and papers that have developed theories that show that sometimes complexity is desirable. There are out there complex financial products that targets many risks. Regulations are to some extent like a financial products that have constrained risk-taking along many dimensions. There is very little empirical research. There is the paper that I am citing there is not about financial regulation, considers non-financial firms in the US, and in general highlights that fragmentation, a manifestation of regulations, is decreasing firm productivity and growth. So, and in the financial literature, there are some starting measure of complexity. So what I will ask here is whether this prevailing view is warranted, or whether in the moment in which we start to distinguish stringency and complexity, we can see that there are states of the world in which complexity is something that is desirable. Let me give you a preview of what I'm going to do and the results. So there are, we start in 1995, we take widely available dating, and then we go to the description of the regulations. We use a large language model in which we compare the regulations that were enacted during this period to have measures of stringency and complexity. And then we ask, what are the effects on systemic risk? We use a widely used measure developed by Viral Ashari and co-author as risk. It measures how vulnerable the value of listed banks is to large drops in the market. So this is really a measure of systemic risk. And in this context, what do we find? Well, if there is an increase in stringency, typically regulations that are stringent and complex result in a decrease in systemic risk. We do not observe the same for regulations that are stringent but simple, less complex. What we observe is that the decrease in systemic risk is only temporary. We estimate very small effects on bank valuation, market returns, and in general private credit, and the negative effect on stock returns we estimate mostly arise from regulations that are lax and not complex. Now, since I use a large language model, panel, this is naturally a black box. So I don't want to only talk about a black box, so I want to make two examples about actual working of financial markets that can justify my finding from what may appear a black box. So what has that Basel III done? Well, Basel III has increased operating costs for banks. What has been one of the main effects that is most discussed in policy circle, well, is the migration of credit from regulated bank to private credit funds that are less regulated. So what does that mean? Well, Basel III, more stringent regulations, don't seem to have affected negatively the supply of credit. Why is that? Well, markets are resilient and find a way to adapt. The question that is currently out there and to which different papers answer in very different way, and I will tell I simply don't know, is to what extent these private credit funds are linked to the banking sector. So what we don't know is what has been the effect of these more stringent and somewhat complex regulations on systemic risk. Let's look at another example. The other example is the leverage ratio, that, by the way, in the literature is largely criticized. Why? Well, banks have to set aside the capital also against assets that are considered risk-free. So what has been shown is that banks retract from low intermediation margin activities like market making in the corporate bond market. This is an example that with Fabio Tikashira, we have looked at in details. Do we observe a market resilience in market making intermediation? The answer is yes. What you see in the first graph is the reaction of mutual funds that provide the liquidity in investment-grade bonds that were mostly intermediated by G-SIB banks in the US, subject to the leverage ratio, that do not find this liquidity provision to be any longer profitable. These are shifted profits to the mutual fund sector. That's why mutual funds engage in this kind of trading. And this is what you observe in the second graph. We measure the mutual fund alpha, that is the mutual fund return above the risk factors. And again, we see that this has increased after the implementation of the leverage ratio. So going back to the message that I was trying to give using the private credit funds, what this shows you is that the markets are resilient. Where has systemic risk gone? Well, of course, systemic risk does not disappear. Systemic risk is just shifted. And what we observe in our paper is that the returns of investment-grade bonds that, because of the leverage ratio, are more intermediated by mutual funds, have become more subject to outflows from the mutual fund sectors. So we observe large increases in illiquidity and a drop in returns when the mutual fund sector experiences in the aggregate large outflows. And this is what you observe in this table in which we focus in March 2020 before the intervention of the Fed. So what does this tell us about the systemic risk? It tells us, well, the systemic risk was no longer with banks, was in the unregulated sector. Is an empirical question how banks reacted to this large shock in the bond market. And this is what I basically will explore in a larger data set with the large language model. So this is, so basically is we wanted to classify regulation based on their stringency, that is how much they increase capital requirement, how much they are increasing the loan-to-value ratios, and so on. But we also want to measure their complexity, how many steps banks have to perform to meet those requirements. How do we do? So these are very many regulations. What you see in the graphs is all the events and the changes that we classify for a panel of countries starting in 1995. While larger language models are known not to perform very well if you ask how stringent this regulation is. But as Schleifer argues in a recent MBR working paper, these large language models perform very well if you make them compare regulations. So what do? We apply their algorithm that is called Gabriel, and is a sort of chess tournament. We make these, we draw at random these regulations, and we compare regulations with each other to come up with scores of complexity and stringency. And this is what we bring to the data. So just the tournament we run is Elo style, where Elo was a famous chess player. And this is what is used in this algorithm. So then we classify the changes. So these are, we compute some scores, but what we really do in the data is an event analysis, an event study analysis that looks at the changes in complexity and in stringency. And of course, a change in regulation changes complexity, and at the same time changes stringency. So we classify the events in 8 groups. First, whether the stringency of the regulation increases or decreases, but then we look at whether the regulation is stringent and complex, stringent and low complexity, and so on. How do we perform the event study? In all of these kind of empirical exercises, it's of course hard or impossible to have a counterfactual. Regulations and their changes are not enacted in a vacuum. So in the moment in which we go from the narrow examples from which I started to these more broader empirical analysis, is not only my paper, but in general, we have to be cautious in interpreting causality. But again, these are, in my opinion, informative correlation. They are a bit more than correlation, because as you can see in this slide, and I won't bother you with the details, we attempt to build synthetic controls, meaning that for a country that enacts some changes in regulation, we create, using econometrics techniques, an appropriate control. So let's get to the empirical evidence. And I think that the more interesting empirical fact that I would like you to remember is that stringency matters, but the complexity is also important. And I want you to observe the 2 top graphs. What are they telling us? Well, I am plotting the measure of my measure of bank systemic risk over time. And what it is showing you is that, well, after the enactment of regulations that are stringent and relatively more complex, that is, there are capital requirements, leverage ratio that are complementary to liquidity requirement, we observe systemic risk to decrease, and during our event window, we do not observe any reversal. The second graph refers to regulations that are similarly stringent, but are not complex, are simple. What do you observe here? Well, this is a byproduct of market adaptation. You observe that in the short run, systemic risk decrease as probably but then financial markets have to adapt. And you observe that there is this reversal in systemic risk. Of course, I don't know, but is the linkages between regulated institution and private credit could be a mechanism through which this reversal in systemic risk realize. We also look at the events that are associated with loosening. This is evidence that must be taken more cautiously. Why? Well, a loosening event occur when something bad happens. But in general, loosening is more detrimental for systemic risk when regulations are simple. So we don't find much negative effect on bank returns. If anything is stringent and simple regulation that decrease bank returns. So let me conclude, is what I wanted to share is a different view of complexity. Simplification is sometimes desirable, but it might also have negative effects if it doesn't allow to fully constrain systemic risk. Thank you.
Thank you very much, Maria Santa. I was afraid that you would circumvent my very stringent time management, but you stayed within with 9 seconds, so that is to be complimented. I know, Enrico, you can do the same.
We'll see. It's an honor to be here to speak on this topic. And let me start by saying that I think this is an important paper because it sort of resets a bit some of the discussion that we've been having on how to go from Basel III to whatever number we're going. And it's clearly a transition, and there is no question the right attention to the need for streamlining some of the construction we place in Basel III. So, I thought the paper was going to be about this. So given the title of the session, there is interesting work on looking at how you have cycles in which we tend to deregulate progressively in good time and until we hit some trouble, and then we re-regulate it. And I remember Charles Goodhart in 2009 saying, you know, let me predict regulation is always pro-cyclical. And it's been around. So, however, the paper is actually on a question that is is even more concrete and actually more technical. It's, I think, more useful than sort of remember the mistake we made, and it's more about what we could do. So, this has been already announced. The question here on the table is how can we do simplification? There is a call for reducing cost. There is a call for streamlining process. What do we lose when we simplify? And I really am very happy that this paper tries to do what I thought was very difficult, measure complexity, and try to find some proper way to test it. So it's very difficult to assess system-wide changes. We don't have counterfactual, and basically, many of the essential issues are qualitative. They are in the legal text. They are, and the solution of the author is, I think, technically very good. I'm no econometrician, but I see the construction in terms of the assumption they make. It's as far as I go. And I'm satisfied. I would have one or two minor points, but I'm probably not the right person to discuss econometrics. I think I take very much on board the fact that they want to separate stringency and complexity, something that for a theorist resembles the classic discussion between how do you formulate a contract or a regulation and how you enforce it. And that is a complex problem conceptually, and you cannot write complete contracts, you cannot write complete regulation. And so the challenge is besides that. Now, we tend to think of stringency as good and complexity as bad. Let me talk briefly about views of complexity. So there is the intellectual attempt in Basel III to calibrate everything, and there are more risks than we can deal with, many we don't know. There being clear intent to close gaps to regulatory arbitrage. I would like to remind people that Basel II was quite complicated, and it wasn't very stringent. And we saw what happened. So I think the detail of complexity matters. So there is a risk, of course, and that's what industry also say, to have overreach, to protect politicians, to protect supervisors. And then you end up with the worst scenario where you have a box ticking, which essentially means that you can hide behind sort of formal steps. And let me remind you, the industry demand. I mean, industry often demands exemption that complicates simple rules, which Basel II could be seen as. Okay, I think in the interest of commenting, I'll skip the summary of the method, but essentially we have AI interpretation of legal text that solves the problem of somehow dealing with qualitative data. There is a sophisticated synthetic control design that essentially tries to project on the untreated set what the reform has been, so that you create this sort of shadow sample. The key results is that, well, statistically, there is a large overlap of complexity and stringency. For sure, complexity is not helpful, although it doesn't seem to have an effect, a significant effect on credibility. Stringency and low complexity fades fast, and that's very interesting. This test look at also the effect over time, and you can see that you can tighten, and the first thing looks better, and then gradually probably the system ecologically work around the barriers. Now, on the other hand, when both are high, you have an impact on this measure of systemic risk. And that is consistent with the notion somehow complexity helps enforcement. So I think I take the insight for our simplification drive, simpler rules alone are weaker. Now, of course, now what I'm going to talk about is what can we take from it. So let's take a moment the notion, take at face value the notion that we have overcomplicated sort of barriers, buffers, norms. Pillar 1 norms and Pillar 2 norms constantly adjusted over detail. I think that we face a situation where perhaps we have tried to sort of create too high dikes against all things that might happen, but once water starts to flow over the dike, we have very few tools. And so I think that if we are going to somehow reduce the sort of level of the dikes, we need to sort of know what to do when water starts to flow over. I discovered that in Holland, people who live near a dike will tell you that a good dike is not a high dike. It's a wide dike. Right. So let me cite Marcus Brunemeyer and distinguishing what makes stability. Stability is made of resistance a system that is built with buffers that can withstand shock. That was Basel III idea. And I think we need to re-emphasize what Marcus stresses, which is resilience, our capacity to respond, because we cannot anticipate where there is going to be weakness. We cannot buffer everything. We cannot overmanage the dikes, but we need to know what to do to act promptly, because dike flooding, just like bank runs, are escalating process. And so timely action is important. And I think one thing I would draw from recent crises is that too often the banks that fail were banks for which there was a lot of forbearance. So I think we need to rebalance supervisory intervention. I do agree that we can streamline reporting, we can work with fewer signals, but make the few we use more salient. So less minute disclosure and perhaps more attention to use market signal. Instead of thinking of pillar 3 like the market should see what is going on, maybe we should also listen to what the market is telling us. This is Viral's point. We need to also look at market signals, something that certainly wasn't happening in the case of Silicon Valley Credit Suisse. We should skip triggers and small tweaking. We should have, however, a clear mandate to empower decisive action when the signals are significant, including market signals that are not prices, such as outflows. And there are tools possible for that. There is a concern the supervisors don't act because they're concerned of triggering market reactions. And that means that if we are going to empower supervisors to act decisively, we need to also think a bit about liquidity backstop. And that I'm not going to have time to talk about. Let me talk about this sort of dike image of resilience. If you put all your sort of resource into the dike, the moment the dike starts to flow over, you have nothing to mobilize. And what we need is reserve or redundancies, as Marcus called them. We need a clear mandate, and we definitely need also the type of dike stock. I won't have time to show you my picture of dikes. But here what you get is the notion of a dike, the delicate point of the dike is not the front, it's the back. When water starts flowing over, you start to have a process of erosion, which is escalating. And at some point, if the back is weak and there is no response, there is a collapse in the back. That's when the flood comes. So there are flood emergency steps, raise, push forward material, place sandbags, redirect flows, use spillways with steps, because those break the flow of water. We can think of tools in the banking domain that resembles a flood emergency measure. Reposition collateral, conversion of AT1 debt, something I would like to talk about it. Redemption charges, which is what money market funds do in case of runs. And since money market funds are where institutional investors that normally invest in unsecured debt deposits go, it seems to me a nice parallel to use. I will take 30 seconds to, thank you, talk about the fact that credibility is what you need in order to stem risk incentive. This is about affecting incentive ex ante, not just about dealing with the mess. And that means that for intervention to happen in time, you need to protect supervisors from run. And that is, I think, should be part of the agenda. If we could create an instrument such as redemption charges, you are changing the incentive of a run. A run is a narrative where you think everybody's running, I'd be a fool not to run. Now, if you start by telling you if you run now today, you're going to have leave money on the table, you have a direct effect, I don't like it, an indirect effect, will other people withdraw after all? And that is what kills in the end in a run. This is about using more signals, including what I call market signals, so market prices and net outflows, and think of a principle that will empower action. Because, of course, supervisory action need to be proportionate and legitimate, otherwise you'll be sued. Well, you'll be sued anyway. I think that was my last slide.
Thank you so much, Enrico. Before opening the floor, Maria Assunta, anything that you would like to react to the reaction to your paper.
Oh, thank you for the discussion, and I want to pick a bit about the issue of ex-post resilience and thinking of regulation as an incomplete contract. Of course, this is what many have proposed, and of course, is in theory very appealing. It causes very little cost ex ante, but it assumes that when risks scale up, we are certain that that is bad risk and is not growth. And in my reading of financial crisis, I think that that is very rarely the case before a miskin moment occurs. So, but is for sure one of the prevailing view, and I'm just not very convinced. So.
Thank you very much. Andrew. Mic is on its way.
Thank you. This was fascinating. I'm really pleased you're using a large language model on Basel. I mean, this is obviously a good thing. My question is the counterfactual, which, if you don't mind, I thought you sort of passed over that quite quickly. But the reason I think it's important is that I don't actually think there is agreement on what the counterfactual is. And my question is, what can we do to try and further getting some better understanding on what that is? Because otherwise, I think this sort of descends into a bit of what we in the UK call a pantomime debate, where, oh, yes, I want more, oh, no, you don't, sort of thing, because the counterfactual is implicitly very different, I think, in this debate. And I think, next step for this work would be great if we could actually try to sort of, harmonize the sort of the view of the counterfactual more.
Thank you, Andrew. Maybe pass it back to Elena.
Yes, Elena Carletti from Bocconi University. First of all, thank you very much both for the paper and the discussion. I think this is actually a very interesting point to make. And I had a little bit the same comment on the counterfactual, because that, of course, is a key. But if I go back to the paper and the main idea of the paper, which is ultimately that complexity can actually help and enhance stringency. That is something that is I wouldn't think that is the common view, quite to the contrary. I would think that we think of complexity indeed as a deadweight cost. So I would like to ask you, Assunta, if you could elaborate a little bit more as to why complexity you think may actually help stringency. Because in the paper you claim that it can actually avoid or reduce regulatory arbitrage. But I think the common view is rather the opposite, that if you have more complexity, you have more room for regulatory arbitrage. So if you could elaborate a little bit more of the reason, and what does that imply then for the simplification versus with equal resilience debate in Europe? Thank you.
Thank you very much. I saw a hand by Claudia Boeg, Chair SSM, and then I will close the first round, but my ball book is growing here. Please, a microphone on the very right from my point of view.
Thank you. The microphone traveled long distance. Thanks a lot for a very interesting paper and discussion. And I think it takes a bit of time to sort through the different pieces of evidence that you presented. The one issue where I would be curious in hearing your view is, and I think it came across a bit in the comment, is of course we have two parallel debates. One is about regulation. I think that's what you focus upon in terms of stringency and complexity. And then we, of course, and this is what Frank alluded to, we have a very big reform program also related to European supervision. So how do we implement the rules that we're dealing with? And there we have also a reduction in complexity, so being more efficient, more effective. But we also work on being more risk-based, being more, if you're in your language, being more stringent, doing escalation, remediation. So I don't know whether you've thought about this, whether this is something you could answer with the tools you have in your paper. Probably not, because you focus on regulation, but whether there's other literature or things you've been thinking about in terms of how can the stringency, complexity of regulation and supervision interact. I think that would be very interesting to discuss. And maybe a quick comment on the comment. So you indicated a bit that supervision should also act upon signals. And of course, I mean, we look at a lot of evidence that we have, but I don't think you can set supervision in that sense just on a very rule-based method. So you need a combination. So what we have is a bit guided this discussion. We do have very clear methodologies, but we also provide space for supervisory judgment with then an evaluation strategy to assess what we do. I think this is the combination you need to have. But thanks again for a very interesting paper and also discussion. Thanks.
Thank you, Claudia. Maria Assunta.
So thank you. So let me start from the counterfactual. So in a study that compares events about regulations, in our model, we have different exposure to factors. We allocate the event randomly and so on. I won't bother this audience with the technicalities, but I think that in that context, the statistical methodology is the best we can. We control for macroeconomic factors, but as I said, I do not consider that causal evidence. Most of my other work focuses on micro examples, and for this reason, I started the presentation of the cross-sectional evidence using these micro examples. I glanced over the paper of the leverage ratio and the shift of market making to mutual funds, but there we have super fine controls and so on. So what I am calling for is for empirical studies that identify when complexity and multiple indicators are necessary. And this brings me to the response to Elena. Of course, it's easy to criticize the leverage ratio. I also show that it changed the market, and perhaps systemic risk didn't go anywhere, but the leverage ratio was introduced for a reason. The risk weight capital regulations had proved to be ineffective in the mortgage crisis. Mortgage-backed security had the rating that did not reflect their risk. And then, of course, were there signals? Yeah, perhaps in August 2007, there were signals, but a president of the American Finance Association at a conference in August 2007, after the market jitters, thought that we had reached the lower point. And of course, I welcome supervision. I welcome the reliance on market signal. We should use all the possible reliable information that we have. I just think that is very hard for a regulator to tell at this point in time that perhaps the private credit funds are accumulating too much risk. Just to make an example from a paper I brought a few years ago that is a bit more related to the first graph that Enrico showed. So I look at banking crisis, and of course we know that credit booms predict a banking crisis, but we also know that higher credit to GDP leads to higher growth. There is a huge literature. So we need better indicators, and in that work, what I show is that when banks that are not established, think new entrant foreign banks, provide most of the credit in the cycle that leads a banking crisis, that this can become an additional predictor of the banking crisis. I identify that credit booms that are not associated to banking crisis do not see this extension in credit of new banks. I think that it would be hard, however, for a supervisor to carve the credit provision by new entrants because there is also competition. That said, is some of what perhaps I erroneously call competition is, for instance, stress testing. And the stress testing is something that might create more regulatory burden, and that is in my data.
Thank you. Enrico.
So to two questions, Elena and Claudia. So on the question of complexity leading to more regulatory arbitrage, let me make three comments. So I think there is a sense in which is true and there is a sense in which is not. So first of all, the first simple question for theorists is who controls the complexity? Basel II was a very capture legislation in which in the end, complexity was constructed to hide risk. So let's be blunt. And it didn't work out well. So if complexity is, it depends which side of the, in a sense, legislation goes. It is also true, so I think that is a qualification. Another thing is that, of course, you get a more complex legislation when the system becomes more complex. You sort of need to, not because in the end the financial system changed with incredible innovation. They are reconfiguration on the same principle: leverage return, diversification, reshifting. You know, we reconfigure it again and again, but you know, it's actually very hard to anticipate and describe in ex ante all the things that can be done. It's easier to tell ex post, which I think is why we should think a bit more about resilience. There is a limit to complexity to control a complex system, but you need some of that. Unless, of course, you have something extremely stringent like leverage ratio that everybody seems to hate. Let me agree on one point. When you have a lot of complexity, it becomes very easy to have it's too much noise. You know, there are too many signals. It's too easy to say 7 out of 8 ticks were fine and only 1 was off. Maybe the one that was off was the right one. So I think having less in the way of maybe fuddling with supervisory buffers or reporting or disclosure. We require a lot of disclosure with a lot of low quality data collected and no one even uses it in some case. So I think we can clear that a bit and make sure that we use less signals. Of course, we look at anything else that we need. But I think the point of having a few signals that are really salient is that you need to protect supervisors. You need to give them the courage or the ability to actually act on a timely basis. Because once and again, I want to repeat, the largest banking losses that we've had since Basel III have been case flagrant forbearance, even though the initial cause may have been different.
Thank you, Enrico. I first go to Eric.
Thank you very much for a really good presentation. So, Eric Thedin from the Riksbank, Sweden. So, first, the point you actually also alluded to, that leverage ratio was actually put into place to handle the complexity of internal models, which was gamed. So, it's a little bit of a paradox that, you know, the most simple rule was actually put in place to handle the increased complexity and gaming of models. So, I think maybe that tells a story. So, and of course, the negative effect of that was partly discussed by you with some of the business going to other sectors. But also I want to ask a question about the political economy here, because we have, of course, an increased discussion about the complexity, the need for change. And it is very hard, I would argue, to defend the current regulation as it is so complex and, you know, just counting pages in regulation, Basel I, Basel II, Basel III, you know, paints a picture of very kind of over-regulated and too complex. So I think, you know, how to frame this and to do you know, some simplification in a way that is politically motivated and accepted. And maybe the final point is that I think more complex rules also makes supervision substantially more complex. And increasingly, supervision today is a legal matter. It's not like it used to be that supervisors tells the banks to shape up and they shape up. It's basically court cases. So the more complex the regulation comes, the more complex the supervision becomes, and hence it's going to be more legal battles. So I think you need to weigh in that as well in the discussion of simplicity versus complexity. Thank you very much.
Thank you, Eric. I'm looking at the clock and I have quite some hands here, so I'm closing the list here. Maybe you can go to Richard, and then Richard will pass it just behind him, and then we move here. Please.
Very interesting paper and very interesting discussion. And it's very interesting that neither the paper nor the discussion talks about the two leading cases of the past few years in 2023, Silicon Valley Bank and Credit Suisse. For Maria Assunta, I would ask whether she thinks that relaxing stringency and complexity, or relaxing something or other, had anything to do with Silicon Valley Bank issues. And I'd ask Enrico whether the disregard for market signals had anything to do with Credit Suisse, in the sense that, there was a slow run on Credit Suisse starting in the autumn of 2022. The deposit base fell by 1/3, roughly speaking, in the last quarter of 2022. Nobody did anything. Okay, should that be one of the market signals that should be responded to?
Thank you, Richard. Just behind you. Please.
Thank you. Elena, London Business School. So thanks for a very interesting session. As some of the results indeed are maybe goes against intuition, I would like to hear a little bit more about what kind of validation you have applied to the concepts of complexity and stringency. These are very difficult concepts to actually measure, as Eric Teddeon just pointed out. For example, indeed, leverage ratio was there maybe as a robustness for more complex tools such as risk weights, which may be badly measured. So any human validation by, I don't know, supervisors or regulators on the measures? And then second, how much of the identification is coming from the type of tool, so complexity residing, as you said, in your measure more in the capital and liquidity tool, as opposed to the borrower-based tools? So how much of the identification comes from these across instruments versus within the types of instruments that we use? I think that would be interesting to know a little bit more about that.
Thank you. Tobias, and then I have one more question here, and then...
Yeah, so the very technology that you use to analyze complexity is also available to the firms and to the supervisors. So it may change the cost benefit of complexity itself, right? Because the tools to deal with complexity are very different from both the firm side and the supervisory side. So have you thought about sort of like the implication of that in terms of, how looking at past data may actually have a kind of structural break due to the very technology that you are using?
Fantastic. One more question here on the second row. And then we close. Thank you.
I'd like to come back to the question posed by Elena and addressed to some extent by Nico too, which is, so maybe complexity isn't the right word to use for everything you want to cover here. In that, I could imagine telling a bank, for example, you shall have this much capital. And the bank going, ooh, you haven't defined capital, so I'm going to do whatever I want to. And then I begin to define it. And you're going to see this as complexity, but I'm going to see it as clarity, actually, which makes it more difficult for the bank to skirt the regulation. So your method might be applicable to separate regulations that achieve an end and regulations that actually don't do anything but impose a burden. And you want to call some of those complexity, but maybe not all of those complexity.
Thanks a lot. So now you are going to have to be concise.
Yes, I will.
And there is no shame in maybe some of the questions being taken up bilaterally afterwards.
Yes,
but here you go.
So let me start saying what I wanted to do, okay? I wanted to challenge the views on complexity and make a policymaker think that sometimes complex regulation might be desirable. The reason why the leverage ratio is, of course, in principle, is much simpler than the risk-weighted capital requirement. But overall, that regulation comes with risk-weighted capital requirement and with liquidity requirement. And this is what the algorithm, partially answering also Hélène's question, capture as the main drivers of regulation, of complexity that largely drive the results. Of course, we will need much more human validation, and this is the start of a project that the ECB has inspired, but I think that sharing a way of reasoning that challenges existing opinion might be important in this context. And then when we evaluate the tools, collecting a bit more data may actually become less costly with this with the new technology, both from the bank point of view and the supervisor point of view. Thank you.
Enrico.
Well, some of the question concern the fact that there is complexity may stand in the way because it might be difficult for supervisor to act. I think this goes back to my notion that if you want to reduce complexity, it is important that you clarify the legal power supervisors around something more salient, something that really empowers them to act. We need supervisory triggers because you cannot have a fully described set of rules, simple and stringent, exposed there'll be judgment necessary. This goes to the richer question. I completely agree. There were strong market signal with Credit Suisse, quantity, outflows, prices, Silicon Valley, the stock price. I mean, there were things screaming out there and there was no action taken because there was no legal power to act on the basis of that. And I think we can strengthen the ability to respond decisively, empowering the legal mandate of supervisor with relatively simple procedure and perhaps so less continuous activism, but more decisive action might be what we need because we can simplify without losing effectiveness.
Thank you, Enrico. One more second, Marius.
Just 1 second about Silicon Valley Bank. I didn't want to get into details, but my understanding is that if the complex regulation was applied and the Silicon Valley Bank was considered a GSIB, the Silicon Valley Bank wouldn't have met the LCR. So the regulation would have worked and enabled the supervisor to start much before, to intervene much before. So.
Thank you very much. With that, I think I can close. Just a couple of sentences. I would say few things in life are black and white. This is true for regulation, where we need to move beyond naive priors, as we have heard. It is also true, by the way, for dikes. Thank you for bringing that up. Dikes indeed should not only be higher, they should also be broader. You are right. But the most sophisticated dikes actually are much more sophisticated because they can open and close according to the circumstances. And actually now the latest is that we are giving rivers back to nature because ecosystem services actually help a lot as well. I needed to throw that in. There's one thing that is black and white, and that is coffee, and that is for now. But Claire, I think I'll have to give to you. Thank you so much.
I'd just like to thank our chairs and all our panelists for some excellent discussions, providing us some food for thought on the way ahead, whether it be with sandbags or with LLMs. We'll now break for coffee. We shall meet back here at 11:10 a.m. local time. Thank you.
I study how the generality of knowledge, its applicability across technology and industries, shapes firms' innovation decisions, market competition, and growth.
My research asks, why do firms grow? I argue that successful firms are those best able to update their production method to adopt efficient capital goods.
I am interested in macroeconomics, and in my work, we study a new dimension of reputation, the public's perception of the central bank's reaction to shocks.
Using theory and high-frequency data from European corporate bond markets, we show that the program reduced borrowing costs for more exposed firms.
I ask a simple question. Do Chinese port acquisitions change the shape of the European trade network?
Using a model and ample microdata, I show that labor scarcity leads to productivity growth. This is highly relevant for a continent of shrinking populations and stalling productivity growth.
In my research, I study why so many workers cannot access better job opportunities. I find that financial frictions matter. When living costs are high and savings are low, workers cannot take the risk of being unemployed in the most expensive cities.
My work quantifies markets' expectations of government bailouts and how those expectations affect bank risk-taking incentives.
In my work, I assess the welfare effects of government aid to homeowners after natural disasters.
I'm interested in macroeconomics, and in my research I study how market power shapes which technologies spread in the economy.
Hope that you all enjoyed the break. It's now my pleasure to introduce the finalists of this year's Young Economist Prize. Each finalist is going to give a short presentation from the stage. Over to you.
Thank you so much for having me. I'm Chen Chuan. I'm a PhD student at Oxford. The motivation for my paper is that we know innovations are the key drivers for long-run growth, but not all innovations are alike. Especially, they differ in the spillover effect they generate. But what we don't know is how do firms respond to spillovers by choosing the type of innovations to conduct. And in my paper, I study this both empirically and theoretically. I built an endogenous growth model where I show that leading firms tend to narrow their innovations in order to limit the spillovers available to the followers, while followers will prefer general innovations in order to absorb the external general knowledge produced by the leaders and upgrade. Empirically, to validate the spillover mechanism, I show that when inventors are less likely to move between firms due to policy change, say non-compete agreements, then leading firms are happier to produce general innovations, while follower firms are discouraged from doing so. Finally, for policy implications, I show that incentivizing leading firms to produce general innovations can promote long-run growth more efficiently. Thank you very much.
Hi, I'm Jérôme Desazars, and I just graduated from Bocconi University. In my research, I try to participate to the question, why do firms grow? In general, for developed economies, we answer this question with innovation. Yet, most firms never innovate, according to our main measure of innovation, patenting. In Europe, as well as in the US, only 1% of firms ever file a patent over their life. Rather, what I find is that patenting is highly concentrated in the hands of capital goods producers. For the rest of the economy, successful firms are rather those that are more capital intensive than their competitors. That is, that have a higher capital to labor ratio or capital stock per worker. Based on those facts, I propose that successful firms are not necessarily better at innovating, but better at adopting efficient capital goods. That is, at adopting the innovation of capital goods producers. To do so, they need to modify their production methods in order to make room and integrate those efficient machines, equipment, or software. Now, this theory of growth has different implications compared to the usual models, in particular because growth is capital biased. That helps explain why growing firms have been piling up sales and capital, but not adding so many jobs. It also helps explain why the labor share of income has been falling, while that of capital and profit have been rising, fueling inequalities. This also has implications for policies, in particular monetary policy, because the interest rate determines the financing cost of capital goods. Thank you very much.
Hello, I'm Katerina Nicolexi from London Business School. Around 90% of global trade travels by sea. And for Europe, this dependence is concentrated in around a handful, 4 to 5 critical deep water ports. Now, we know from economics that infrastructure shapes trade, that ports matter. But what I ask is different. I ask whether who owns ports matters, whether infrastructure ownership can shape trade as well. I studied this using the staggered acquisitions of European port terminals by Chinese state-owned investors and built a novel hand-collected ownership database on these acquisitions and combine it with more than 1 million truck-level shipments that span the entire single market at the subnational level. I exploit both historical differences in port reliance across regions and industries and the institutional details around these acquisitions to identify the causal effect of these acquisitions on the shape of the trade network. So what do I find? I find that historically more reliant regions experience relatively lower trade volumes and relatively higher trade concentration in their partners, consistent with the reconfiguration of trade corridors. Ownership matters because it can change the incentives at these strategic nodes, and especially as Europe builds its resilience amid geoeconomic fragmentation, it's increasingly important to understand these network effects on top of the real effects. So thank you very much.
Hello everyone, my name is Lennart Miermann and I'm a PhD student at Cambridge, going on the market this fall. Now, imagine for a second the following. Assume that you're a policymaker and that you want to understand how a change in monetary policy affects firm investment. How do you go about this? Now, on one hand, if you cut rates as a central bank, this should mechanically bring down borrowing costs in the economy, boosting firm investment. But on the other hand, it's been shown that sometimes financial markets become more pessimistic in their economic outlook around such rate cuts. So that could potentially do the opposite and actually disincentivize investment. Now, in the paper, we decompose the aggregate investment response into these two opposite channels, a structural borrowing cost channel as well as an offsetting information channel. And we do so by exploiting a particular episode in 2016 when the ECB announced that they would purchase large quantities of corporate bonds. Now, this is useful for us because we document in the paper two things. First, we document that this announcement drove a wedge between the yields of certain eligible corporate bonds relative to certain other ineligible European corporate bonds. And secondly, we show that otherwise comparable European firms were exposed to this wedge to different degrees, which gives us this nice cross-sectional variation in firms' borrowing costs that's orthogonal to any belief revisions around the program. So from this, we can back out the structural elasticity of just a change in borrowing cost for firm investment. And we find in the paper that this is actually much bigger than previously thought. So we find that an average monetary policy shock transmits about 1/3 less than the structural elasticity would suggest. So the key takeaway of the paper is that belief revisions around monetary policy shocks matter a lot. And if you want to understand how different shocks transmit to the economy, it really is first order to also understand how these shocks affect firm beliefs about the future of the economy. Thank you very much.
Hi, My name is Luigi Falasconi, and I'm from Italy. I graduated from the University of Pennsylvania, and I'm interested in macroeconomics and finance. My work quantifies markets' expectations of government bailouts and how those expectations, if anything, affects bank risk-taking incentives. Combining a structural model with asset prices data, I show that lower bailout expectations account for most of the post-2010 increase in bank credit spreads and funding costs, and importantly, helped push banks to take on less risk. Now, what's the key takeaway, especially in an audience like that, is that the credibility of policymakers matters. When markets believe regulators' promises, those promises can indeed change optimal banks' choices and indeed strengthen financial stability. Thank you very much.
Hi, my name is Marina Hoch from the University of Mannheim. My work speaks to the recurring debate about government aid after natural disasters. I ask, what are the welfare effects of the existing government aid programs in the United States? In a quantitative general equilibrium model, I find that the US economy is better off compared to a no-aid scenario. However, welfare could be improved by changing the policy design. My paper is the first to provide a framework that allows for the interaction of government aid with insurance demand and mortgage default. So why is mortgage default important? On the one hand, it reduces the incentive to buy private insurance, creating a commitment problem and generating room for government intervention. On the other hand, it is an insurance itself and therefore should reduce the value of providing aid. I proceed as follows. So first, I show an attractable model that mortgage default generates room for government intervention. And second, I develop a quantitative incomplete markets framework to do policy analysis. So what do I find? First of all, welfare is raised by 0.25% in consumption equivalence variation due to government aid, and these gains are entirely driven by the high-risk region. So the low-risk region is almost indifferent. Intuitively, you might expect that low-income households would oppose aid because they're more likely to rent and hence subsidize the rebuilding of homeowners. However, this group benefits most in the high-risk region. So despite the gains, I find that it generates substantial distortions in the insurance and housing market. So insurance demand declines and also the risky housing stock increases. Therefore, I propose alternative policy designs that target these distortions. The key main takeaway is that making rebuilding grants independent of insurance coverage of homeowners would lead largest welfare gains. Thank you very much.
Hi, I'm Max Marchnack. I just graduated from Oxford. I'm now about to join the University of Oslo in Norway. In my research, I ask, how do economies adapt when labor becomes scarce? For the first time in history, many countries around the world are about to see their populations fall for the first time, and we know little about what that might mean for growth and for inflation. To answer these questions, I turn to history, and I study a plague outbreak in Northern Europe 3 centuries ago. In granular trade and production data, I show that economies adjust to labor scarcity by adopting more capital-intensive technology and by innovating. This results in a striking productivity growth, which is of course directly relevant for our aging European economies, as such productivity growth is the key ingredient to sustained economic growth. I also find that labor-scarce economies pass on their productivity gains in the form of lower export prices to their trading partners. That matters for inflation and potentially for trade and industrial policy as we trade with other aging economies around the world. You may think about East Asian economies here. Now, this finding of productivity growth is contingent on actors across the economy actually being exposed to labor scarcity in the form of higher wages. Labor market institutions that shield individual sectors or individual firms from the necessary adjustments hinder productivity growth, as producers then face no incentive to adopt new technology. The first policy takeaway, therefore, is to promote labor market institutions that generate competition for workers and incentives to adopt technology. I also show that the depth of capital markets can be a critical limiting factor in economies' ability to adjust. The takeaway here is to promote capital market integration in the Eurozone in order for economies to be able to structurally adjust once labor scarcity arrives. Thank you very much.
Hello, thank you for having me. I'm Pedro Martinez Brera. I just graduated from MIT and I will join the IMF this fall. In my work, I combine theory and data to study reputation for the central bank's reaction to shocks. First, I build a model to show that reputation affects the sensitivity of short-run inflation expectations. So even when long-run inflation expectations are anchored, a central bank with a good reputation will be able to look through shocks more. So reputation is an intangible asset, and to build it, the central bank needs to react more strongly to inflationary pressures than the markets expected. So this mechanism has two sharp predictions. First, that reputation responds to monetary policy surprises, and second, that reputation reduces the sensitivity of short-run inflation expectations. And my model is informative of how to measure reputation in the data and how to test for these predictions. Using cross-sectional variation of private forecast data for the US, I find that this mechanism is not only present in the data, but also quantitatively relevant for the design of monetary policy. So overall, my work shows that reputation matters beyond anchored long-run inflation expectations, and central banks should react aggressively to inflationary pressures to build it. Thank you very much.
Good morning, everyone. I am Simone Zanella Cavallero from Pompeo Fabra University. In my research, I study why so many workers cannot access better job opportunities. I find that financial frictions matter. As we know, there exist large differences in job opportunities across space. Big cities tend to offer better career prospects, but are also the most expensive places to live in. And the growing affordability crisis has made cities increasingly inaccessible, especially for financially constrained workers. Yet, the role of wealth in shaping workers' careers remains largely overlooked, and my paper contributes to the literature by addressing this gap. The paper proceeds in 4 main parts. In the first part, I start by developing a quantitative macro model where workers' wealth interact with local labor market characteristics, shaping their job search and migration decisions. In the second part of the paper, I use rich administrative data from France to document heterogeneity in labor market outcomes across both the wealth distribution and French commuting zones. In the third part of the paper, I take the model to the data to quantify the role of wealth and the heterogeneous job ladders in accounting for wage and wealth inequality. Finally, in the last part of the paper, I study the consequences of a policy that increased the generosity of the local unemployment benefit in the most productive and expensive places. The main takeaways of the paper are that financial frictions significantly limit workers' ability to climb the spatial job ladder, and that improving unemployment insurance in the most expensive places has positive welfare gains, which are concentrated among financially constrained workers. Thank you very much.
Thank you very much to all of our finalists for getting here and for doing such excellent presentations. I'd like to remind you all in the room that they'll be around for the remainder of today in the foyer to answer any questions you might have. Also, you can vote for them using the QR code on your badge, and you have until 9 a.m. tomorrow morning to do so. AI looks set to become the most consequential technology of our generation. But what does it mean for the stability of the financial system? Our next panel brings together perspectives on this topic from international institutions, central banks, academia, and the markets. It will be chaired by Isabel Schnabel, member of the ECB's Executive Board. Dr. Schnabel, over to you.
Thank you, Claire. Where are you? Oh, there. Thank you, Claire, for your introduction, and good morning to everybody. It's a great pleasure to welcome you to our panel on artificial intelligence and financial stability. We are in the midst of a technological revolution, and AI holds great promise. boosting productivity and efficiency, fostering innovation and new business models, and improving decision-making across the economy. And of course, these benefits also accrue to the financial sector, which has rapidly adopted the new technology. AI-based instruments have been used in the financial sector for some time. For example, for credit scoring, risk modeling, and algorithmic trading. What has changed, however, with the latest generation of AI is its ability to generate new content, to synthesize huge amounts of unstructured data, and to even provide a form of analytical reasoning. And how this alters the drivers of financial risks and what policymakers can do about it will be the focus of our discussion today. One theme that is currently discussed in financial markets is the potential emergence of a financial bubble driven by AI. You probably all remember how Charles Kindleberger described the financial cycle in his famous book, Manias, Panics, and Crashes. So the cycle starts with an innovation that is seen as improving profit opportunities, leading to a boom in investment, rising asset prices, increasing leverage, and at some point, euphoria. But once prices decouple too far from underlying fundamentals, a small trigger, like a change in interest rates, can be sufficient to lead investors to exit, confidence to fall, the system to deleverage, and asset prices to collapse. Will this time be different? Or are last week's stock market events in South Korea and elsewhere the harbinger of more to come? Risks are compounded by concentration. Both the financial sector and the real economy, at least in some countries, are increasingly dominated by a few large and rapidly growing companies. These companies are making up an increasing share of global stock indices with similar trends in global debt markets, implying correlated exposures of asset managers across the world. And the same companies are also providing the models, the infrastructure, and the underlying data and services, thereby increasing operational dependencies and giving rise to just another correlation. It is not hard to imagine a cyber attack on a major cloud provider bringing down many financial institutions at once. And the debate about mythos provides a stark reminder of how AI is heightening vulnerabilities by increasing the speed and ease with which cyber attacks can occur and propagate through the system. So the question is how to respond to these emerging risks from a corporate and a policymaker's perspective, and how international collaboration could help us mitigate these risks, ideally via preemption rather than crisis management. And the challenges go beyond cyber defense. Understanding how autonomous AI systems navigate the complexity and uncertainty inherent in financial decisions, and how this could lead to market malfunctioning, correlated behavior, and pro-cyclicality is of paramount importance. And given the significance of this topic, I'm very happy to welcome my fantastic panel consisting of 4 experts who will offer complementary perspectives on the implications of AI on financial stability. Each of you will have no more than 10 minutes for your introductory remarks. After that, I'm going to give the panelists the chance to respond to each other. I may also ask some questions myself before opening then the floor for the Q&A. So, my first speaker is Sarah Breeden, who is Deputy Governor for Financial Stability at the Bank of England. And she's one of the few policymakers working at the intersection of financial stability and technological innovation, leading the Bank of England's work on financial stability, the supervision of financial market infrastructures, payment innovation, and fintech. So Sarah will give us the policymaker's perspective on the implications of widespread AI adoption in the financial sector. Sarah, we are very happy to have you. The floor is yours.
Thank you.
Look, thanks, Isabel. It's a real privilege to be here to discuss AI and financial stability. In fact, it's hard to imagine a more timely or important issue. AI really is reshaping finance at speed, and it's on us to ensure that tech surprise doesn't become a test of financial stability. The apparent acceleration in AI capabilities creates a double challenge for us central banks. Not only do we need to enable responsible adoption and manage risks, we need also, as the panel this morning highlighted, to recognize that AI should transform how we go about doing that job. Recent advances also suggest an inflection point. We've already moved from generative AI systems creating content on request to them reasoning through requests. But now with agentic AI systems can autonomously chain together sequences of actions. So the financial system looks likely to evolve quickly into one that operates more autonomously, at scale and at speed, with AI agents transacting on behalf of consumers and merchants, devising and executing trading strategies in financial markets, and identifying and chaining together cyber vulnerabilities. My most proximate financial stability concern right now is what the UK government's AI Security Institute has described as a step change in agentic AI cyber capability. In the hands of defenders, these tools strengthen cyber resilience. But the immediate risk is that in malicious hands, they materially increase the chance of attacks that could harm financial stability. Now, cyber resilience has long been a priority at the Bank of England, working with our National Cyber Security Centre, as it has at other central banks. In May, the bank, the FCA, and the Treasury set out practical steps for financial institutions to prepare for frontier AI-related cyber risks. The bottom line was that getting the fundamentals of cyber hygiene right is more important now than it ever has been. But that gives us only limited comfort. AI is uncovering many vulnerabilities that we need to patch, including as global software providers and key UK financial institutions use the latest models. For financial stability, patching must happen quickly across the financial sector, across key third-party technology providers, and across the wider national infrastructure too, like energy and telecoms. That is no small task. It's also an urgent one. As the heads of the Five Eyes cybersecurity agencies said just last week, the timeline is not years, it's months. Open source models may lag the most advanced closed models by only 4 to 8 months, and their safeguards can be breached. If patches are released but not swiftly implemented, malicious actors can reverse engineer the vulnerabilities they address. And so for central banks, this increases the onus on us taking a system-wide approach to operational resilience. Stronger firm defences are essential, but not enough. Firms must also respond to and recover from disruption quickly, whether that disruption is from a successful cyber attack or from patching itself causing operational disruption, as many of us remember from the CrowdStrike update in 2024. Authorities should therefore place higher likelihood on simultaneous multi-firm disruption, enhance tools to stress test that impact ex ante, and strengthen mechanisms with industry to coordinate ex post. We also need to consider whether regulated firms need enhanced recovery options for their core systems. In financial failure, we have deposit insurance so customers can still access their money, and we have bail-inable debt, so the largest firms can continue to provide services. In a cyber context, do we need systems that allow one institution to pick up another's basic functions during disruption, as in Ukraine's power banking program? Or do we need requirements for key firms to have completely separate cold failover capabilities, or to be able to rebuild compromised core systems quickly from bare metal? These are big questions, but they're the important ones. Turning to agentic trading in financial markets, evidence suggests that for now, trading firms mostly use autonomous AI for lower risk operational tasks such as research, but that could change quickly. And if AI agents respond similarly to the same prompts or triggers, they could amplify volatility and stress, especially if their objectives drift from their original goals or public policy objectives in a manifestation of the misalignment problem. That means that our financial stability question broadens from whether firms can use models well to whether the system can observe and contain the resulting behaviors. Now, we have some experience of structured multi-round stress simulations in the UK, focused on how financial market participants behave as they learn of each other's actions. But AI increases the importance of such work and indeed can transform how we go about doing it. We're experimenting with the BIS Innovation Hub and the Bundesbank on simulation methods to understand which aspects of agent design could drive herding behavior. And that work can explore mitigants, whether markets using AI agents are resilient enough, whether agents' objective functions could incorporate public policy objectives, and whether guardrails are needed, analogous to circuit breakers or kill switches that would limit or stop trading market-wide if faulty AI models cause market meltdown. More broadly, AI should transform central banks' monitoring and risk assessment. Agentic technology can combine qualitative and quantitative data to generate insights and scenarios for how the current conjuncture could go wrong, potentially even using a digital twin of the financial system to simulate interactions between participants. Turning lastly to e-commerce and payments, consumers and merchants have so far mainly used AI agents in recommendation mode, with humans still executing transactions. But as agentic technology advances, tech firms, payment systems, and merchants are all working to automate that final step. In the UK, the bank's leading a public-private partnership to design our next generation of retail payments infrastructure, and that will ensure it can support agentic payment journeys. But the biggest issues here are likely to be for regulation and for industry standards, how users securely give consent and authorization to agents, especially for multiple transactions, how disputes are settled and liability assigned for erroneous or fraudulent transactions, and how authorities avoid fragmentation and walled gardens as AI firms and payment systems develop protocols for agents to interact with themselves and with merchants. Agentic commerce and trading both show that as AI capabilities increase, we must keep asking ourselves whether our existing tech-agnostic regulatory frameworks remain sufficient. Our frameworks were not built to contemplate autonomous agents. Relying on a human in the loop for all agent transactions is unlikely to be realistic. So more sophisticated governance and accountability frameworks may well be needed. Let me conclude. I think we need policy frameworks, internal skills, institutional structures ready for more frequent tech surprise, cyber risks, agentic trading, and agentic payments and commerce are the applications at the top of my list today, but that could well look different in a year, if not sooner. Scenario analysis and how we prepare now in the light of that scenario analysis will be key. What if the next surprise puts the latest capabilities in bad actors' hands? What happens if models develop in ways that are harder to evaluate and control, given the evidence we have that some behave differently in testing compared to real-life scenarios? Cooperation with other parts of the official sector is vital. Drawing on AI security institutes, model testing, and strengthening resilience through domestic AI capabilities and capacity, for example. But the same applies internationally too, including in the Financial Stability Board and the G7. The global financial crisis underlined how interconnected finance is. That's the origins of the FSB. And the challenge of AI is similar. The impact of new AI capabilities can spread across borders through common technology dependencies, globally systemic financial institutions, and common market infrastructure. And as you said, Isabel, we shouldn't wait for a crisis to build the cooperation we need with other central banks, regulators, and finance ministries. The Bank of England stands ready to do our part to ensure we get responsible AI adoption and through it support sustainable growth. Thank you.
Excellent, thank you very much. So my second panelist is Tobias Adrian, who is Financial Counselor and Director of the IMF's Monetary and Capital Markets Department. Tobias, as you know, is one of the most prominent experts on systemic risk, and he sets the gold standard for research-driven policy making, combining outstanding academic achievements with rich policy experience. So Tobias is going to examine how AI is reshaping the financial system from a markets perspective. So Tobias, we're looking forward to your contribution.
Thanks so much for having me here, and it's really a pleasure to contribute to this panel. So I was going to start by first addressing some of the challenges that Isabel posed at the beginning, which is really about the valuation of artificial intelligence firms and whether that is representing a systemic risk. And then secondly, I'm going to complement what Sarah was expanding on, which is the question of how AI is actually changing the way that financial intermediation is done and what that means for financial stability, and of course, what is the policy punchline around that. So let me start with the valuation question. So when we look at the broad market, take the S&P 500, because of course, many of the technology firms are located in the US, the major firms are there. So in recent weeks, we have actually seen quite a bit of a reversal of valuation pressures. So when we look at historical valuation pressures, they were in the 95th percentile, even 96th or 97th percentile on a couple of days. And those have reverted down to the 80th percentile. So there's not as much valuation pressure anymore that you saw recently. And valuations are very much related to price-earnings ratios. And so it's both the prices that have come off a little bit, but it's earnings that continue to surprise on the upside as well. So that brings me to my second point on this topic, which is that profitability is really at the core of the run-up in stock markets that we have seen in recent months and years, right? So profitability expectations in the technology sector have been extremely aggressive for many, many months, and earnings have continued to surprise to the upside, right? And that is really quite different from sort of bubble-like behavior, right? And so, when we look at the cross-section of firms, in our assessment, market discipline is functioning quite well. So, for example,
you saw, chip makers continued valuations going up. But on the other hand, software has been selling off tremendously because, of course, AI is a threat to the software sector. So we don't think that market discipline, market forces have been diluted all that much, which again, in a sort of bubble-like behavior, you would expect that, there's quite a bit of a dilution of market forces. Now, of course, what is quite worrisome from a financial stability perspective is that the major tech firms are starting to leverage up themselves, right? And so oftentimes those are the hyperscalers that are investing in chip technology, which can age, fairly quickly potentially, and they're issuing debt, which is medium or long term, and so there's a potential maturity mismatch in between the duration of the physical assets and the duration of the debt. And so as long as profitability continues, as long as corporates and individuals are paying, for the frontier model costs, that is probably fine because profitability is going to stay elevated. But at some point, of course, there could be a disappointment to earnings. That could be to the sector as a whole, or it could be to some firms so that, among the firms, some survive, others don't survive. But I think it's really the underlying profitability that is the key financial stability issue at this point. So let me now go down a different rabbit hole, which is about, how is AI changing the financial sector? And again, this is very much complementary to some of the themes that Sarah was already talking about. So the first thing I wanted to focus on is lending. So how is lending impacted by generative artificial intelligence? Of course, loan officers have been using quantitative techniques for many years, right? This could be, statistical analysis. These are, credit records. And this can be machine learning enhanced by many of the credit firms, card firms, banks, etc. Now, generative AI, when we talk to market participants, to banks, they're saying it is really a transformative technology. And the way I think about the transformation is that it is an augmentation, right? Just as in the way in which we are using AI to look up a literature review, to look up a track record of a central banker in terms of giving speeches or so, I think loan officers are using AI to augment, their own capacity. And that may be very powerful and may open a lot of higher productivity in this area. But of course, it can also lead to more agentic loan decisions, right? So fully automated decisions. So models may discover new lending opportunities that were previously undiscovered, similar to these math proofs that we read about that were around for a long time, and suddenly the AI models come up with new proofs that mathematicians are surprised of that they didn't come up with the proofs themselves, right? But then, are these discoveries really resilient if there's a credit market downturn, right? I mean, that is the key question. And how do supervisors assess those kind of agentic loan decisions? They are a little bit black box. There's potentially a lack of explainability. And I think that is a key supervisory challenge. As was already mentioned, of course, standard setters and regulators have put out guidance around this. But ultimately, we really have to see how this is playing out through a credit market downturn. Hopefully it's going to go well, and hopefully, what we can do from a public sector point of view is going to be sufficient, but there are certainly, a lot of questions that will remain open for some time. Now, let me secondly turn to AI-supported trading. And of course, we have seen automated trading for many, many years at this point, right? In liquid markets, equity markets, on-the-run sovereign bond markets, and FX markets, the vast majority of volume is already automated, right? I mean, this is high-frequency trading. It's completely done out of models. And the way I think about generative AI in this world is that the development of trading strategies can be enhanced tremendously, right? So traditionally, people had to code those trading strategies, backtest, and both the coding and the backtesting can be, much quicker. So you can have much quicker time to market of any trading strategies, to roll it out, to test it, to backtest it, and then to take it off the market potentially if it doesn't work. There's also, opportunity to upgrade enterprise platforms and, upgrade the data and operational infrastructure. But of course, what we could see is that, this sort of automated trading, ultimately the agentic trading, is also going to migrate to less liquid asset classes, right? So that we may see an acceleration, in particular in a downside scenario, in less liquid, less centralized markets. And the kind of kill switches and circuit breakers that were mentioned may not work that well in private markets and in those less liquid markets and over-the-counter markets. So I think the speed ultimately is going to arrive in less liquid markets as well. But what are the policy tools? The policy tools that have worked in these very liquid markets may not work in the less liquid markets. Finally, I think I have 2 minutes. Let me finish with risk management. So again, AI does present opportunities to enhance risk management, right? So for example, a risk manager may be better at detecting anomalous behavior of employees, right? A risk manager may be better at understanding what is going on in an option trader's immensely complex trading book, right? Options trading book. And so, there's, I think, and of course, a risk manager may be better able to detect fraud or coding errors or so. So I think there's certainly potential for risk management to be enhanced. But on the other hand, of course, the risks from bad guys using this technology for either fraud or cyber attacks is also increasing. So, the most sophisticated firms probably are fine, right? Because they're at the technological frontier. They use the most advanced models. They have the human capital to defend themselves. But when you think about the financial sector around the world, in countries outside of the most advanced countries, in smaller firms, even in advanced economies, are firms going to be able to protect themselves against those frauds, against those cyber attacks? And when you think of the most outrageous attacks, they're often attacking the weakest link. So to finish, I think there are 3 things to think about from a policy perspective. What does augmentation mean in decision making? How is speed going to evolve in potential downside scenarios? And how do we address this explainability gap from a policy and supervisory perspective? Let me stop here.
Thank you very much, Tobias. And I now turn to our third speaker, Itai Goldstein, who's professor at the Wharton School of the University of Pennsylvania, and he's a key expert on the role of information for financial fragility. And in his latest truly fascinating work, Itai uses simulation-based experiments with AI agents to study the implications of AI use in financial markets. And today, he will build on these analyses to shed some light on how autonomous AI agents affect the functioning of financial markets and what this may imply for policymakers and regulators. So it's great to have you here.
Thank you very much, Isabel, and thank you to the organizers for having me on this panel. I think I have slides that should be uploaded. Yes. So I'm going to give you a perspective from research that we are doing on AI trading in financial markets. And the angle that we are focusing on, which I think is what is truly unique about AI, is the fact that AI is autonomous. It can make its own decisions. This is what we think of as agentic AI. So what we would like to think about is how introducing those autonomous algorithms into financial markets, how it is going to affect the equilibrium in financial markets. So first of all, what is AI-powered trading? So we heard from Tobias already that algorithmic trading has been already very common for quite a few years. But what is unique about AI-powered trading is that the algorithm is learning how to trade, and it's making its own decisions by learning from experience. This is what we call reinforcement learning. What you see here in the picture is AlphaGo, which well before ChatGPT, I think, gave the world a scare that AI can be something quite serious by winning against human in this highly complicated game. And this is based on reinforcement learning, which is basically what we are playing around with in our research, thinking about what it does in financial markets. The implementation, if you want, at a very basic level, is quite simple. It's called Q-learning in the professional jargon. But it's basically, think about an AI algorithm that is trying to learn over time what is the best action to take in every state of the world. So it's maintaining this database, which is kind of this big matrix. On one dimension, you have different states of the world. In the other dimension, you have different actions. And every period, you have to take an action in a given state, and you're basically updating what is the payoff that you're getting if you take action X in state of the world Y. There are two key parameters that govern how these algorithms are going to behave. One is the degree to which they maintain memory of previous transactions rather than keep updating based on the new ones. And the other one is the extent to which they experiment, explore new actions, or exploit what they already learned in the past. And these are the hyperparameters that you put in the system. With these in place, the reinforcement learning algorithm is going to try different things, explore different things, and learn what is the best action to take in different circumstances. So when you're thinking about risks to financial markets, to me, the key question is not how these reinforcement learning algorithms are behaving on their own, but rather how they interact. And this goes back to what Sarah was saying, that we need to think about the systemic implications, how these algorithms are interacting with each other, and what ultimately this does to the system. Suppose that now we have a financial system that is populated with these algorithms just running around and trading. What are the implications of this? Now, you can say, well, these artificial intelligence algorithms are just going to mimic human intelligence. But I think there is a growing consensus that it's not quite the same. And that whatever intelligence, if you want to think about it as intelligence coming out of artificial intelligence, it's not quite the same as human. The other thing to point out is that from a legal/regulatory perspective, there are quite serious challenges here. Because when regulators are trying to prevent market collusion, market manipulation in a world with humans, the idea was always to look for signs of communication, coordination, intention. But with AI, you will not find any of this. They just learn how to do it. They don't really communicate. They don't really talk to each other. So it's going to look quite different. So what we have done in a couple of papers, and I'm going to give you the highlight in a second, is to use an experimental research approach, which is basically to experiment with AI algorithms trading in a financial market environment and see what kind of behaviors they end up exhibiting. And this is a research approach that I think is quite easily available and implementable when you're thinking about AI algorithms, because you can do a lot of experiments. Unlike with humans, if you wanted to do experiments with humans, you need to put them in a classroom, you need to explain the rules, you're limited with time and resources. Here with AI, you can really do a lot of experiments. So we can really learn a lot about their potential behavior just by simulating the environment and seeing how they behave. Also, the issue of external validity that we typically worry about with human experiments does not arise with AI. Chances are they will behave in the real world just as they behave in the lab. So I'll show you a couple of snapshots from research that we have done. And this is with my colleague at Wharton, Winston Du, and Yan Ji, who is in Hong Kong. And this is based on running a lot of simulations, and I'm obviously not going to bore you with the details here. In the first paper, what we looked at is whether these AI algorithms learn how to collude. The definition of collusion here is behavior that is not competitive, where they basically learn over time that they should hold back, not compete so aggressively with each other, because this is how they maximize their long-term profits. What you see here in the graph, this is kind of the highlight result from the paper. Basically, what you see is the profits that they obtain from trading, and the horizontal axis is the amount of noise in financial market. To the right, the market is more noisy. To the left, the market is less noisy. And when they obtain higher profits, it indicates that they learned how to collude because the competitive profit is lower. Competitive profit is the red benchmark that you see in the graph. So what's interesting is what we see from many rounds of these experiments is they tend to find ways to achieve a collusive outcome, either if the market is not noisy or if the market is very noisy. Okay? In the middle, they don't manage to maintain that. It's also interesting that the mechanisms, when you look under the hood and try to understand what mechanism exactly is supporting this kind of collusion, the mechanisms are quite different. When the market is not noisy, they manage to maintain this collusive behavior that is quite intelligent based on price trigger punishments. You know, when you think about collusion, it is, we all know we're not going to act competitively, but if I see indication that you acted competitively, I'm going to punish you. So to the left, where the market is not noisy, it looks like they are indeed achieving this kind of understanding and this kind of collusion. To the right, on the other hand, when the market is very noisy, this kind of collusion breaks down. They still manage to achieve a collusive outcome, but this is mostly by learning bias. And this is why we sometimes refer to it as artificial stupidity versus artificial intelligence. But it's interesting to see how, in both cases, they emerge with higher profits. In a follow-up paper that I will only spend a few seconds talking about, we are looking at something that is even more advanced and potentially more disturbing, which is the ability of these algorithms to coordinate on a manipulative path of prices. If you're thinking about manipulation in financial markets, typically what you would have in mind is speculators somehow coordinate to increase the price of an asset, and then it falls down, and they make a profit on the upside and downside, which is quite a sophisticated strategy to achieve. You know, if you think about meme stocks, for example, something that we have seen recently, it turns out that with a slightly more sophisticated Q-learning algorithm, these algorithms indeed manage to achieve this kind of manipulation, creating bubbles, leading to crashes. And this, I think, has more significant implications for financial stability. So I will just conclude in 30 seconds. I think it's important to understand how AI algorithms behave and how they interact with each other. If you want, this is the psychology of AI traders. The experimental approach is readily available here, and that's what we have been using in those two papers that I mentioned to you. And the analysis shows that they exhibit patterns of collusion or manipulation. All of it should be of concern to market regulators. We have some ongoing research also trying to understand the interaction between AI and humans and who has the advantage when, but I'm not going to get into that here. Thank you very much.
Excellent, thank you, Itai. So finally, I'm very delighted to introduce our fourth speaker, Thorsten Slock. Thorsten is chief economist at Apollo Global Management, and he's known by many as the king of charts. If you have not subscribed to his newsletter, it's very interesting. And he's a true expert on fixed income, private credit, and equity markets, and he will provide a macro financial perspective on AI's potential implications for financial stability by its impact on households and firms. So looking forward to your contribution.
Thank you so much. So I should also have a presentation that we are pulling up here as we speak, but I want to talk about three things that are adding to the discussion that we had so far. First, I want to talk about what is the impact of AI on the economy in the US at the moment. I'll also add a little discussion about what we're seeing in Europe. Then I'll talk about, secondly, what is the impact on financial markets? And thirdly, there's also another impact that is also important to emphasize, namely, what does this mean for demand for US treasuries? So with that agenda, let's first look very simply at the US economic outlook. And this is literally the consensus expectation from Bloomberg. And what you see in this screen here is that the white numbers is the 60 people who submit their forecast to Bloomberg. This is the median of their forecast of what do they think will happen to the US economy over the next 7 quarters. And the first observation is in the second line. GDP growth over the next 7 quarters is basically going to be around 2. So that's good, that's potential growth, that's what the Congressional Budget Office says is exactly where we should be in the long run. So the first observation is, the consensus is telling you that the US economy is not growing too much, not too little, it's growing exactly at the 2%, which is a long run growth rate. And the next question that becomes important when we talk about AI is to ask, well, where's that growth coming from? Historically, a lot of growth has come from the third line, namely the US consumer. But what's interesting at the moment, as you can see, US consumer spending is going to grow actually a little bit less than 2% over the next 7 quarters. So that's a different way of saying it's really not driven the growth outlook by anything that has to do with the consumer as such. Instead, most of the growth is going to come from private investment. Private investment, of course, involves very significantly the data center build-out, the energy build-out associated with data centers. And you can see the growth rates there are very high relative to overall GDP growth. So one very important conclusion is that AI and the data center build-out and the energy associated with data centers is playing a very important role in the growth outlook at the moment. So when we think about what are the implications of AI in the economy, the first observation is we are seeing a very strong tailwind coming from the AI spending boom. In fact, if you do backward engineering of asking the question, well, how much does AI contribute to GDP growth at the moment? We calculate that both the CapEx spending boom and also the wealth effect coming through the consumer is adding about 1 percentage point to GDP at the moment. So GDP normally grows at 2, and now about 1 percentage point is coming because of AI on its own. And the last point in the outlook is the squared box in the bottom. There's a lot of debate about what is AI doing to the unemployment rate, what's AI doing, is it labor enhancing, is it labor replacing? And you can see that the consensus speaks very clearly here, namely that the consensus is saying that the unemployment rate is going to go down. So this is importantly telling you that there is certainly a lot of arguments why this could be wrong. This may not be the right outcome. There could be all kinds of things why this could be higher or could be lower. But at least the collective wisdom of the 60 people who submit their numbers to Bloomberg, they are saying they are not expecting mass unemployment as a result of AI. That's a different way of saying the expectation is that it really is true magic coming to the US economy, both through strong labor markets and also, of course, through strong productivity gains. So that's a key backdrop for a discussion about financial stability, namely that the US economy is truly enjoying all the benefits from the AI boom that we're seeing at the moment. And let's now ask the question, well, what does it then look like for Europe? Well, this is the same screenshot from Bloomberg for Europe, also the consensus expectation. And you can see here, obviously, for the reasons we know very well, and we're debating today, and of course also that we'll be debating on the sidelines of the conference, namely that AI is not, unfortunately, a tailwind to the outlook for Europe the way it is in the US. Instead, we still have decent growth in private investment coming from, of course, defense, coming from renewable energy. But the story also when it comes to AI on the impact on the economy in the last line in the chart is that also for Europe is not expected to see a dramatic rise in the unemployment rate. So the first conclusion is AI is truly having a very incredible impact on the US economy. We are also seeing some tailwinds to growth in Europe, but they're just coming from different sources relative to the source of growth that we're seeing in the US. And the final point on this is when we think about what this means for the forecast, is that remember, if we do have an AI boom, that generally is not sensitive to what the Fed is doing. Likewise, at the same time, we have the one big beautiful bill, which is also not sensitive to what the Fed is doing. So the discussion often, of course, has been around, well, if we have some sources of growth that are not sensitive to interest rates, well, what is then sensitive to interest rates is, of course, housing and autos. So those sectors are not doing very well. But the traditional textbook of thinking about what are the sources of growth at the moment is telling you that in the US, we have some very unique sources that are not particularly sensitive to what the Fed is doing, and it's not particularly sensitive to what's happening in the long end of the yield curve. So the first conclusion is that the US is, of course, enjoying tremendously the growth coming from the AI boom at the moment. And the mirror image of this is that this is exactly also what we're seeing in financial markets. This chart here shows you for the S&P 500, what is the share of the 10 biggest companies in the S&P? And you can see, as we all know, the Magnificent Seven have done incredibly well. Their market valuations have gone up a lot. And at the moment, they make up about 40% of the index in the S&P 500. But it's not only the S&P 500 that AI is playing a very important role. It's also in credit markets and in venture capital. This chart here shows you for this year, to the left, what has issuance been in investment-grade credit. And as you can see, 49% of issuance in investment-grade credit has been AI-related. So this, of course, is the hyperscalers that need to finance $700 billion in data center build-out. That's a different way of saying it's no longer just the case that AI is in the equity market. AI is actually also in credit markets. Likewise, for high yield, you can see to the right, 38% of issuance has also been coming from AI. And finally, if you also look at venture capital, it used to be the case that venture capital was pharma, biotech, prescription drugs, inventing new medical products. But now venture capital has also changed dramatically. 87% of venture capital is also AI. So if you now sit down with your 60-40 pie chart and think about investing, well, it used to be the case that the design of the 60-40 pie chart was done in a way where if I had some equities, I had some bonds, well, if equity prices went up, normally bond prices would go down, and vice versa. If equity prices went down, well, normally bond prices would go up. So the stroke of genius in the 60-40 portfolio was that there was a natural hedge that I would be exposed on the one hand to bonds and to equities, and if one thing did well, the other thing would not do well, and therefore I would normally have a very well-designed portfolio that would take into account a balanced approach to investing. But the problem today is, as you can see in these charts, is no longer just the case that AI is everywhere in equities. AI is actually also everywhere in fixed income, and is actually also everywhere in venture capital. So now we wake up with our pie charts in asset allocation, and I have AI as a factor in equities, I have AI also as a factor in credit, and I actually also have AI everywhere in venture capital. So there is one thing that we have learned in finance in the last 15 years, it's factor investing. And suddenly there's one factor that literally is everywhere in financial markets, and that is, of course, AI. So that's, of course, why the risk is, if you do have any slowdown in AI profitability, as Tobias was talking about, if there is any chance that AI is accelerating, that will begin to have some very important implications, not only for the GDP forecast, but also ultimately for financial markets. And it's no longer just equities. Again, hyperscalers issuing IG corporate debt is also playing a very important role. And the last point in this is, of course, that this also becomes important when we think about what's going on in treasury markets. And that's what you see in this chart here. This chart here is simply just a yield curve for US treasuries. So let's just walk through what are the reasons why US interest rates are still quite high, and what are the risks that US interest rates could still be under some upward pressure. So in the front end of the yield curve, we have upward pressure because of inflation. This is a debate. Is the Fed going to hike? Are they not going to hike? Do they need to hike? what is the inflation outlook, and that, of course, has been a very important reason why interest rates have remained very elevated in the front end. In the long end, we've had the very long-dated discussion about the fiscal situation. Obviously, government debt is on an unsustainable trajectory. Deficits are unfortunately very significant, and we also have, unfortunately, a path from the CBO that says that the debt level will continue to move higher. But the new development is in the belly, on the middle of the yield curve. If you are a bond manager in investment-grade bonds, you would normally buy two things. You would either buy treasuries or you would buy financials. But given that the hyperscalers are also now investment grade, that means that as a bond manager in investment grade, I can now not only buy treasuries and financials, I also now need to spend some money on buying hyperscalers. So there is a crowding out effect that is also beginning to have implications for how I think about investment grade assets, and in this case, of course, what this means for US treasuries. So the risk to the outlook, which becomes important also for financial stability, is that there's upside pressure on rates coming from the front end because of inflation. There's upside pressure in the long end because of the fiscal situation. And now we also have that AI, or in this case, the hyperscaler issuance, is also beginning to play a role in terms of demand for US treasuries, in particular in the belly of the yield curve. So the bottom line is, when we think about the financial stability risks, at the moment, the economy in the US is doing incredibly well because of the tailwinds from AI. It is playing a bigger role in financial markets, but it also has this other subtle effect on demand for US treasuries, which could potentially have some implications for how we think about the yield curve, and especially now the new pressure point coming from the belly, where hyperscalers are crowding out demand for US treasuries. So with that, let me hand it back to Isabel, and we can have a good discussion. Thank you.
So thank you very much to all of you for a fascinating presentation. So maybe I start with a few questions, and after that, if you want, you can still respond also to each other. So let me actually start with Sarah. So, I mean, both of you talked a lot about this feature of the AI models, that they are a bit like a black box. And that, of course, poses challenges for like regulators and supervisors. And maybe you can say a few words, again, how you would deal with that. And the second question, I mean, you already mentioned some things that can be done, but I mean, are the supervisors, the regulators, the central banks equipped in the sense that, I mean, do we have the people who can do all of that? So have all these people not been trained in very different ways, and how do we deal with that?
Let me start. I'm sure Tobias will have a lot to add. We already have model risk management standards, and what we found from talking to the industry who are looking to apply these model risk standards in an AI context is we need to evolve them a little bit. It's not that they're wrong, it's just they need evolving. What do I mean by that? You can't explain the model itself, but what you can do is understand the inputs, check the outputs, and have somebody accountable for those. So your frame changes, the way you go about achieving the outcome of confidence in your model needs to be changed somewhat. The single most important thing, however, is having somebody accountable for that model. We talk about human in the loop. We're not going to be able to have a human in the loop for every single agentic decision that's made. So what does human on the loop mean? Where are you getting signals that's telling you your model's malfunctioning and you need to go in and do something about it? And then your final point about skills, we are certainly working with industry in order to make sure that we have those skills. The sorts of things we've done, for example, is set up an AI consortium. We have in there the finance companies, the tech companies, the hyperscalers and the labs, and we have academics round the table and try and crowdsource knowledge to make sure that we're best placed to be able to answer those questions. But my best guess, Isabel, is that we're going to have to invest a lot more in this as we look ahead.
Did you want to add something?
Yeah, absolutely. So I think on the one hand, of course, you know, the artificial intelligence models are models that you can ask questions to, right? So in principle, you can ask them to explain why they took those decisions, right? So in that sense, there is some degree of explainability, but of course, how they came up with those decisions, that is very difficult to understand. And it seems to me that the main pitfall here is the market-wide interaction, right? So even if we understand what is happening at a specific firm level, how the strategic interaction is going to come together is going to be very challenging. So let me again make a parallel here to high-frequency trading, right? So in high-frequency trading, we have some understanding of what the algorithms are doing, but I think it's fairly limited, right? So we don't have as granular of an understanding of, high-frequency trading, machine learning, or now generative AI type of models, as we have, say, for risk management models in major firms, right, where clearly supervisors have a deep insight. Now we have figured out that there were flash crashes, and the flash crashes are a system-wide problem, and we put in market-wide circuit breakers, and that sort of like solves the problem. So we know the medicine without necessarily understanding everything that goes into it. And I think this is where Itai's work is so important, right? As in terms of pointing to, this challenge that system-wide interactions could be quite different from what we understand at the firm level in a novel way relative to the way that we have understood those issues, the procyclicality of haircuts and, the procyclicality of underwriting standards, all of that which we understand now fairly well in classic financial stability. I think there's a whole new set of amplification mechanisms that we have to get a better handle on, and ultimately, that is the challenge.
Yeah, so actually, I think you're right. I mean, the work that Itai has done with his co-authors is fascinating. I mean, what you find is truly troublesome. So we basically need to be concerned about kind of market functioning, market integrity, and so on. So you haven't talked much about it. What, in your view, can be done about that?
Right. So I think it opens the door to a lot of questions. I will say, following what Tobias just said, so we knew that high-frequency trading was already using algorithms for a long time, and we knew that these algorithms are highly complex, and there are very few people, if at all, that understand exactly what's going on. I think the additional power that you get here from the AI, or what we call AI, is this element of reinforcement learning, whereby they don't really follow what you told them to do. You just tell them, go out there and maximize this profit function, and they find their own strategies, and then their interactions and all this are extremely hard to predict. So I think that when it comes to regulating financial markets or maintaining the integrity of financial markets, what you need to do is you need to really go back and think about a new approach. It can't be that we are just looking at explicit coordination, communication, explicit intent, because you're not going to find that in the code. But rather maybe by looking at what is the outcome, and then if the outcome is something that you think is not desirable, go back and try to understand what is causing it. Kind of paradoxically, I think one way to do it is with algorithms. So regulators are also employing their own algorithms to identify this kind of behavior. But of course, you have to be careful not to go into a race here where it's just algorithms chasing algorithms.
Yeah, thank you. So before I open up for the floor for questions, I would like to come back to this question about the potential AI bubble. So Tobias was, I would say, relatively benign on saying after the recent correction, maybe we shouldn't worry too much. So first I would like to know whether you share that view, and then you also made an interesting point. I mean, historically, if there was a bubble, very often the bubble burst when interest rates went up. That's kind of a historical regularity. So you're saying this time this would not be the case. Maybe you can say a few words about both points.
Yeah, ultimately, as Tobias was saying, it's about the profitability. Is the revenue there to pay the hyperscalers? Is the revenue there to pay all those companies in the infrastructure in particular that need to get paid for the services that they provide? If you ultimately have that AI is wildly successful, well then it will in the extreme case result in a very significant increase in the unemployment rate. And if we have 20% unemployment, well then of course we'll have all kinds of problems with income growth, we'll have all kinds of problems with consumption going down. That could generate a very bad scenario because then consumer spending will go down and therefore ultimately we would like to get a recession because that would be on its own not a good scenario for those who would be losing their jobs. On the other hand, if AI is not going to deliver on all the promises of productivity gains, well then a lot of the investments that are made today will of course turn out to be more problematic because then they will not be delivering the returns in terms of productivity, profitability, and that's the discussion around token demand, token optimization. We've in the last several months heard a lot of discussions around, well, companies are now figuring out that tokens are very expensive, so now it's an optimization process. That means that token maybe costs are going to go down. But if that's the case, does that also mean that the revenue for the hyperscalers are going to go down? Does that mean that people will be switching to Chinese models, which are much, much cheaper? So there's a lot of unanswered questions when it comes to what is the path ahead. But the bottom line is, at this point, I don't think anyone knows if this is a bubble. But I do think that at this point, it is still a lot of finances have been put in place. The case that this is certainly contributing significantly and playing a very significant role. So overall, in my view, I still think that we should view this that it will be a revolutionary technology. There will probably be some bumps on the road, but it is very clear that all our lives as we speak are getting changed because of AI and will continue to change because the demand for compute, it's indisputable, will basically only go one way, and that's namely going up.
Thank you very much. All right, so we are ready for questions from the floor. I have Joachim, Jeremy, Ricardo. Yes, you will get it.
So thank you so much for this very interesting panel. I would like to come back to 2 points. The first point is related to co-learning and maybe coupled co-learning. This is really a concern in relation to market behavior, market manipulation. If there is maybe a kind of a, let me say, a tacit collusion, how to maybe get to an agreement within or between the AIs to optimize this strategy. Is there any, let me say, measure? I can see it when I'm talking about high-frequency trading. We have these circuit breakers. Yeah. But how can I do a circuit breaker for an AI or two AIs? They are working together in a collaborative manner. I have no clue about this. So maybe you have an idea here. And the second point is very interesting, related to the crowding out aspect of the treasury curve. And I believe this is not only true for the treasury market, because when the hyperscaler overconsume funding, then they're doing this also for the rest of the market. So for a corporate not being maybe such a hyperscaler, it's more difficult also to get access to credit. Is there something you can also see in the data, or is it only what you only find for the treasury market?
Thank you very much. So we collect 3 questions, if that's okay, and then I give it back to you.
Yes, thank you. I have 2 questions. So the first is to Tobias and Thorsten. So for those profit expectations to be validated, is the main thing that needs to happen that, you know, productivity expectations happen as we hope, or do you also need rents and essentially profits not being dissipated by competition? Because that seems, you know, something that is possibly a taller order, right? So how much of that is built in? And then on Itai's super interesting work. So this question is almost certainly stupid, but I'm going to ask it anyway. So one of the things about these AI models is they seem very obedient compared to humans, right? They're not intrinsically devious, maybe the way humans are, and of course you're getting your results because you have this Q-learning, which is pure profit maximization. So is it not really easy to avoid manipulation and collusion just by telling these models not to manipulate and to collude. So effectively build in guardrails into them. And could this not be done in a simple way?
Thank you.
So I want to follow up on Torsten's forecasts from the Bloomberg survey and what they imply for the macroeconomy and for finance, and also what that then implies for financial stability. One view of AI is that it has led to a big increase or reduction in the life cycle of investment products and increase in depreciation, which would be consistent with your Bloomberg forecast that said that investment is going to be forever higher. I just need to invest more because I'm always replenishing. But of course, that would not lead to growth or to high stock market valuations, quite on the opposite in some ways. If we're just replenishing a capital, now depreciates faster. A second view is that AI leads to a lot of productivity. It's going to lead us to be much wealthier. That would explain potentially high stock market valuations, but not those somewhat disappointing 2% GDP growth forecasts. I mean, if it's really such an improvement in productivity, why don't I see it in growth? And a third view is that AI will rather lead to an increase in market concentration. We're having a lot of investment because I want to become the leader, in which case that would justify some of the profitability forecasts, but not so much would lead necessarily to either growth or even to sustaining of investment, because once I've become the leader, we'll have a huge investment slump as I've now become the leader, I no longer compete. So whether I look at future investment, output, or stock market valuations, or profitability in the words that Tobias was using, I have very different scenarios here of what I think this AI boom is, and what they imply, therefore, for the different asset classes, the treasury, as well as whether credit goes across them, is really, really very different. And I would argue, I would claim perhaps the key question. So this big investment boom, what do you guys think is it about? Is it which of these three alternatives it is? And how do you think that will impact our ability of financial markets to adjust to the very different valuations and needs for credit of them?
So who would like to start? We go this way again.
I'm happy to take Joachim's question on collusive behavior. I think there are three things that we can do. The first picks up on the question that was raised after you, which is try and embed public policy and regulatory objectives in the constitution of the AI model so that it is required not only to make money, but to do so in a way that complies with the relevant regulations. So that's kind of step number one. Step number two is then thinking about how do we use AI to help us monitor and mitigate the risks of AI in markets. It's a timely analogy at the moment, though I feel bad saying it to a German. An AI lab said to me, the referee is on the pitch in a football match, and so use AI to help you do your job. So I think that's one of those transformations that we need to look at, and it goes to the experiment that we're doing with your team. And then the third thing is to test, to use simulations, the kinds of technologies that Ite described, to just see what works and what doesn't work. AI is a great enabler of us being able to do different things. So I think those three things should help us better deal with the collusion point. The only thing I'd say by way of conclusion is that an AI expert told a number of us that AI is a bit like teenagers in that they lie, they tell you they've not done things when they have, and they behave differently when you're watching them. So we do have to be aware of that as we do
Let
our
me just
testing.
maybe follow up on
Yes,
that.
sure.
So I completely agree with those solutions or strategies. So I think the two questions about Q-learning were related. First of all, what can we do? And second, can we do something specific to prevent it? And I will say, it's a little tricky because at the end of the day, it's not like you code them to allow for manipulation. And what they do is not illegal. They just find ways to act in a way that is not competitive, in a way that is potentially generating manipulation. just in order to maximize their profits, but there is really no explicit coordination, explicit communication. And this is what I think makes it tricky. So I think that potentially putting something in the code that says don't do this, don't do that could help. The question is, how do you do that? I mean, is that something that a regulator will now come and say, whoever wants to use this kind of strategy, this is how you need to code your algorithm? That might also take us to a regime that is using too much regulation. So I think the balance here is quite tricky.
Yeah, so let me address two questions. So one was by Jeremy and Ricardo to some degree, which is about the profits and how does that fit into the macroeconomy. And the second one is about the yield curve. I'm going to perhaps jump in as well, though, of course, it was asked to Thorsten. So on the profits, there's, of course, some degree of monopoly brands that are priced into the profits. How much comes from imperfect competition? It's a little bit of an open question. I think a big threat to profitability are open source models, right? I mean, open source models are, not quite at the frontier, but they're, pretty close behind, and they could eat into profitability at some point, right? They haven't done so yet, but I think that is a major kind of risk. And, at that point, these investments could look not that great, right? And so from a financial stability point of view, I think what worries me the most is that there's leverage by the borrowers and there's leverage by the investors, right? So the borrowers are leveraging up, right? There are 3 trillion or so of investments by the hyperscalers, either already in train or coming in over the next couple of years. So there's clearly more leverage, there's clearly more debt issuance in all these markets that Thorsten underlined, but there's also a lot more leverage from the side of investors. So there are leveraged ETFs, there's margin debt that is at record levels. And so the leverage on both sides is very worrisome for financial stability. Getting to the yield curve, right? I mean, we have seen long-term yields going up, also in the belly of the curve. Yields have been, so here I'm looking at the real yields, right? So real yields have been going up, particularly far into the future. And, is that reflective of higher productivity growth into the future or of term premia, right? So when you do sort of like standard decompositions, quite a bit of the ratcheting up is actually due to term premia, i.e. it is risk that is being priced in the real yield curve. Term structure implied R star hasn't sort of like shot up. Now, there's of course, model risk in there, but I do think, term premia are a bit of a worrisome sign saying that there's a mismatch between demand and supply in the real yield curve, right? Abstracting from the inflation issue, of course.
Yeah, so just to Joachim's question, absolutely. If someone comes with $700 billion on the market and say, would you like to buy this? Well, if I'm a bond manager, I need to find money to buy the $700 billion. So in that sense, it is absolutely crowding out not only US treasuries, but across the board in credit, and therefore also begins to raise questions about what's the spread between hyperscalers relative to industrials, relative to banks. And you might even begin to be worried about, well, if I'm a global fixed income manager, what does that mean also for European fixed income markets, and not only having an impact on US financial markets. So absolutely, anytime any financial market grows, especially the speed with which hyperscaler issuance has been growing, it raises all kinds of questions, not only about that asset class, but really the simple question, where are the $700 billion coming from to buy the bonds that hyperscalers are selling at the moment? And to Jeremy's and Ricardo's question, absolutely. If I take my finance textbook out, and let's say that we in this room, we invented Ozempic. We would have a product for the next 3-4 years where we would have monopoly. No one else had Ozempic. This was a very nice product. It will give us very nice profitability for a number of years. But what is the product today? A bit what Tobias was talking about. It's a large language model. But it's really difficult for me to figure out the 7 large language models I have on my phone, what the difference is. So you end up saying, if there really is a much more competitive landscape where it really ultimately is so competitive that the price of the model itself is going to really, in particular with the Chinese models in mind, to converge down to very, very cheap and ultimately maybe even zero. Well, that then becomes important because then it's not like Ozempic where I invented a new product and I have some market power. It really is much more the value becomes, well, how are the models then used? And that's why, to your question, Ricardo, exactly, there's so many different scenarios. Is this going to generate a dramatic amount of productivity? We're not quite seeing that yet. We have seen a little bit of uptrend in productivity in the last 2 years. But if this generates a lot of productivity, it will really be the miracle drug for the US economy that can generate so much more productivity. And at the same time, in my view, more employment that will be solving a lot of different problems. But if on the other hand, this takes longer time, especially if it takes time relative to where valuations are today, then it will be a completely different scenario. So you're right. Absolutely. That's why looking at the consensus forecast on the Bloomberg screen, I stare at that a lot of times with the whole scenario in mind. What do people think? And I think people at the moment are saying there's a lot of building of data centers, a lot of building in energy. At the same time, the unemployment rate is not going up. But then, well, that could happen exactly as you're saying under many different scenarios. And the asset price implications would be wildly different as a function of exactly, is the depreciation rate so quick? Is this because there's new capital coming? Is it other assets that people have in mind when they think about CapEx spending in the very high, strong forecast that we have? So I couldn't agree more. Ultimately, this is all about, is the revenue going to be generated to pay for those investments that are being put in the ground as we speak here today?
Thank you. So we have another round of questions. I start with Tiff, please.
A microphone up here. Yeah, sorry. He's coming there.
There's a coordination problem.
Well, thank you. And this has been a fabulous panel. I wanted to focus on AI and trading. I mean, one thing that's very interesting about, the analogy to high-frequency trading is very interesting, and I think arguably there are some sort of non-competitive strategies in high-frequency trading, so it's not totally new. But what is interesting in the market is that high-frequency trading coexists with institutional trading, retail trading. But when I'm listening to you, I'm like, a poor person trying to trade in your setting, they don't have a chance. And I'd be interested in the panel's views on sort of what does this look like, once this really goes mainstream. I don't see how any other trader is going to have a chance against the reinforcement learning. And you could certainly see in the transition, the reinforcement learning, I think, could probably do a really good job of exploiting the errors of judgment of retail traders to generate huge returns. So I'd be interested to see sort of what the panel thinks. Secondly, I thought, you've got a whole research agenda following up on Sarah's suggestion, build public policy objectives into the reinforcement learning. It would be very interesting to see, the AI is super smart, so those would have to be very carefully designed, or they could have unintended consequences and be further manipulated. So anyways, I think that'll be. And then my final question is there anything we can do about the market structure here? I mean, one thing I have in mind is, so if you had two AI agents, collusion would be very easy. If you had 100, it probably gets harder. If you have 1 million, have you looked at that? Like if you have more and more, does it get harder to collude? Are there structural things we could do to try to reduce collusion?
By the way, on your first question, it also affects us, right? We are also in markets from time to time. That's right. So my next speaker is Shepnan and then Yumana.
Fantastic panel. I have a related question to Tiff. I'm surprised nobody talk about the positive that can come from integrating AI to trading for monetary policymakers, for central bankers. We are in a room full of central bankers. And one thing is, of course, very high frequency FX trading, right? So the international arbitrage deviations stemming from the segmented currency markets is a bottleneck for the international spillovers of monetary policy. So what I understand is if somehow we can train them not to collude and we can integrate them to the FX trading, exactly as Tiff's saying, I mean, this entire arbitrage profit is going to go away and they will do the job of the monetary policymaker, of international coordination of monetary policy. Markets will do the job. So how possible is that? So how from an international perspective, we can coordinate on something like that, controlling the risks?
Can you just hand the mic back?
Thanks a lot, Jumana Salihin, Vanguard Europe. My question is linking back to what we heard this morning on innovation. How do we encourage the good actors to innovate and grow? And really what we're hearing much more on this panel is more about the risks from the bad actors. So how do we balance the good versus the bad? And what I'm really concerned about is, given the structure and the size of firms in Europe, that the burden of regulation could actually slow down the AI adoption that we heard earlier, so that it would become slower and lower in Europe. And actually, some of our research shows that already, that regulation may not be proportionate. And then quickly on reaction to Tiff's question, we're also seeing a disintermediation of the markets and how markets move. So it's not all algorithmic trading, right? We are seeing a rise of the digital. You know, Vanguard is very much on looking at the retail investor, and people are using the digital platforms, and AI is advising them, and we are seeing a lot more agentic flows to websites from those digital platforms. Thank you.
Thank you very much. I take a fourth question. Jon, please. Over there.
So a couple of inputs into this. If you look at the pricing of models, and now you have Chinese models being at basically 10% of the cost of US models, and Anthropic is accusing the Chinese models makers of reverse engineering what they're doing. So given the fact that we have these US firms that are already losing multiple billions of dollars, facing competition where the price has to go down very significantly, what is how do you see the impact of that on stability? But the main question I had is something slightly different on directly what happens in crisis. So what we do know in every financial crisis is that private sector bank stop supplying liquidity into the markets, withdraw it directly and park it at the reserve account at the central bank. And if you and the crisis response of central banks is geared towards, and that's why we supply liquidity in crisis, that's the lesson of 2008. And let's layer AI on top of that. So we have the treasury function of banks is one of the biggest users of AI, not the biggest, but second or third. So the banks are actively using AI in day-to-day liquidity management. And then if AI is so good at, so therefore in a crisis, a bank has a binary decision. Am I going to run or am I going to trade into the shock? So if the shock comes along and then you have the AI, and what we also do know, this is in response to some of the previous questions, AIs are very good at colluding. So this is a well-known fact in the AI literature. Multiple AI systems running independently, they study the ex-post outcomes of other AI systems. So therefore they learn and they create communication channels that are not visible to anybody else. So therefore we layer that on top of liquidity management using AI, being very quick in making decisions. And then are the central bank response facilities fast enough to respond to that? And if they are not, that endogenously makes a crisis more likely. Just wondering if you had any thoughts on that crisis vector.
Thank you very much. I take a final question, but then we have to be relatively quick in answering.
Thank you very much for the excellent panel. Actually, I have a question regarding the presentation from Mr. Goldstein regarding the trading of AI agents. Actually, they're trading the financial products that we know. But what in the situation if the AI will start to create their own financial products which we don't understand? What then? How to regulate it, how to control, and how to, what that can have the implication of the financial system? Do you have any research on that? Thank you.
Thank you very much. Very interesting question. So we start on this side this time.
Well, I think most of the questions for the other panelists here. So
but still, you can.
Yeah, so I think there were a lot of interesting questions. So one question is about the market structure, and I think this is indeed important because in those experiments, as you increase the number of algorithms that are trading against each other, collusion and manipulation becomes less prominent. So I think this is one viable avenue for regulation. Right now we know in high-frequency trading, for example, there are typically a few large market players that are dominating. And I think this is the kind of environment that lends itself to this collusion. But if you try to force more competition, I think this can certainly help. There are also other results that come out from the experiment on how you design the algorithms and what make them less prone to collusion and manipulation. Those are things that go into like super technical definitions. So there are two hyperparameters that control the reinforcement learning. One is how much they remember the past versus update from recent experience. The other one is how much they explore new strategies versus exploit what they did in the past. And it turns out that if you can play around with those things to make manipulation or collusion less likely. But again, this is the kind of thing that I would say is probably very difficult for regulators to actually implement, to go and tell firms, you cannot have this degree of memory, or that's probably very difficult to do. I mean, I think the question about new financial products is obviously very interesting. I mean, the concern about moving to an AI economy where you start delegating more and more actions to algorithms and to machines, there are just many more concerns. I think what we see here is just really the beginning of it, but we will certainly see more concerns as some of these activities are moving to machines.
Thank you. Do you want to respond?
Great questions. And honestly, Tiff, I don't think we know the answers to them yet. But what I do think we can do is use the experiments that we're doing to explore whether there are characteristics of markets that mean they will be more resilient to the kinds of manipulation and collusion that we're worried about. So it's on us to do that work quickly. Jemana, you raise a great point about how do we encourage good innovation here. We can't fight cyber unless we have AI. We can't fight fraud unless we have AI. Let's make sure that we have sandboxes, we experiment, we're open, and we work with industry to try and identify where regulation might be getting in the way of adoption, and as appropriate, smooth through that. And then my final comment would be in relation to the what if we get new financial products being created. I'll share with you an anecdote from a fireside chat that I did with a very senior member of the Silicon Valley tech community when I raised many of the questions that we've been talking about here today. When I said, aren't you worried about how AI and agentic AI can lead to problems in financial stability, market crashes and the like? And he said, Sarah, I can see why you'd worry about that. Think about that in a military context. And I think that's a broader point, that many of the issues that we've been talking about today actually have resonance across many different domains as well as financial stability.
Thank you, Sarah. Yeah.
Yeah, let me also start with Tiff's suggestion to think about market structure. And again, I would use an analogy to high-frequency trading here. I mean, I think the firms that are not doing algorithmic trading and are still making money, I think they're doing it in a different, they're offering different services and different products, right? So I think it's very hard to compete with the algorithms if you don't use the algorithms. But I would say that even in the most liquid markets like US Treasuries, they are the central limit order books where the trading is done, but they're also dark pools for large trades, right? And that goes a little bit in the direction of, wouldn't the algorithms or the AI, the agentic traders, generate their own trading locations, right? And how do you prevent that, right? Do you, somehow prevent them from doing trading outside of certain trading venues? I think these are very hard questions because already we see that there are all these other trading venues that are emerging. On the question about AI for central banks, I'm sure, many central banks in this room, I think probably all central banks in this room are heavily investing into AI. I just want to advertise something we have been doing at the IMF. So we have pulled all public records of central banks over over more than 100 years across something like 120 countries, right? So we pull all of these records, and then we generated our own agent in order to classify central bank communication along policy lines. Is it for monetary policy, for liquidity provision, for regulation? Is it aimed at the general public, at journalists, at financial markets or so? And so basically, this kind of tool can help central bankers to detect how communication would be perceived by an AI agent. And when we look, for example, at our website usage at the IMF, the vast majority of visitors are LLMs, right? There are very few people that are still coming to our website. They are going to ChatGPT and are getting the news, and these agents are scraping the website. So it's a completely new world for central bank communication. There's also a new world, I think, for central bank liquidity injection, right? So when you think about a crisis, right, and then you have not just high-frequency trading, but also agentic trading that is then going to take into account what you do as a central bank, I think it becomes a lot more complicated, right? So it goes beyond what the Bank of England, of course, has been doing all these standing facilities for non-banks. And I think that is, then you can think about high frequency, but then thinking about how do you inject liquidity in an agentic world, I think it's a whole new frontier. I haven't really seen much work on that to date, but I think that's perhaps for next year or so.
Yeah, thank you. Thank you very much. So, unfortunately, okay, very, very quick one.
Sorry, I'm sorry, I misspoke. You're
okay,
right. You're
there
right.
wasn't two
They're
ends.
contingent facilities. I'm sorry.
So I'm afraid we have to come to the end of this fantastic panel. I would like to thank the four of you for fantastic presentations, a very engaged discussion. I will not be able to summarize everything, but I think what is clear is that we're facing, especially with agentic AI, we're facing a fundamental transformation of the financial system. We have huge benefits, but we are also facing large risks. I think many of you said we should focus on the systemic implications in particular. We should focus on strategic interactions between agents. And we probably have to step up our own AI capabilities in order to respond. So I very much liked your analogy with the teenager. So the good thing about teenagers is that eventually they grow up and some of the problems disappear. But AI is also going to grow, but I'm not sure the problems are going to disappear. Let me end with that and wish you a nice lunch.
I'd just like to echo what some others in the audience said and just point out that this has been a really fascinating panel on some of the risks stemming from AI, and as Deputy Governor Breeden also said, teenagers too. So that's it for our morning sessions. Please join us back here in the room at 2:30 p.m. local time. For those of us here, lunch will be served downstairs. That is unless AI has eaten it first, so be quick. Hello and welcome back to the afternoon sessions of day one. Artificial intelligence is reshaping economies as we speak. This afternoon's first conversation will bring together two different vantage points on how those changes are coming about. One is from inside one of the world's leading AI companies, and one is from a central banker who's been thinking a lot about the implications for the macroeconomy. I'd like to now welcome the two economists onto the stage. We have ECB Executive Board member Philip Lane and Ronnie Chatterjee, Chief Economist at OpenAI and Professor at Duke University. Thank you.
So we only have 45 minutes. So I don't think I'm going to spend 10 minutes explaining what AI is and so on, because we've had already quite a lot this morning. So let's jump into it. So we will talk through some topics, but then I would encourage you to line up your questions, because I'm sure that this rare opportunity to have someone from inside the machine, if you like, with us today is highly valuable. So Ronnie, thanks so much for coming along. And let me just start with, what exactly does the chief economist of OpenAI do? And more generally, what is the work agenda for the economics group at OpenAI?
Well, Phil, thanks for having me. Great to see everyone here today. It is an honor to be at the ECB Forum. That question, what does the chief economist of OpenAI actually do, was exactly what my wife asked me when I told her I was going to take the job. And at the end of the day, there's been a tradition of economists working in industry. A lot of my colleagues from grad school went to work in tech or banking or consulting. It wasn't something I expected to do. I've been an academic. I worked in government a couple different times in the US, but I wasn't expecting to go work inside an organization. But the value proposition for me was a couple things. One is we're generating all this data around AI usage for individuals, enterprises, and across different products. ChatGPT, the chatbot generation, reasoning models, the O series, and also agentic tools like Codex. And they wanted someone to come in to actually analyze that usage data to try to understand what was going on. And for the first time in my life, I had this opportunity to do the research I wanted to do inside a private sector organization versus in academia. And so for me, that was one big determinant. The second thing was just the environment and who I was working with. I work with a lot of people who are much younger than me, building things that I could never imagine. And when I get the opportunity to learn from them and hear how they're approaching their work, it's made me a better economist. And I think even as a faculty member on campus with a lot of young people, it can be very hierarchical. The old model where I listen to what my dissertation advisor says to me, and I tell my next set of students something else. With these folks, it's much easier for me to learn both ways. And those two things, the access to data and the ability to work with these amazing scientists, was the reason I joined OpenAI.
Very good. And I'm sure as we go along, what you've learned from the OpenAI data will show up in some of these questions. So let me jump to the productivity question. And let me divide it into potential. So what is the potential of AI in terms of task automation, in terms of the capabilities? And then maybe part two of that is the potential to transform the innovation process itself. Because again, in terms of really boosting the growth rate of the economy, if you can accelerate innovation, that's quite something. But let me bracket that kind of potential question with the weakest link issue, which is what can slow down the ability of the world economy to adopt AI and to take advantage. So capabilities versus implementation difficulties.
Sure. So we divide our work at OpenAI on the economic research team into three areas that touch on these points. One is a focus on jobs and growth. If you're an economist studying AI and you're at a cocktail party or on the sidelines of your kid's football match, they're going to ask you, hey, what do you think about AI and jobs? That's the question you're going to get. We spend a lot of time on that. The second issue is around enterprise adoption, which I think is going to be the big driver of productivity. People are really focused on consumers, but enterprise adoption and the deployment of AI inside organizations is the unlock. The road to AGI goes through enterprises and organizations, and that's something that's really important for our team. And the third area is what I might call sort of a post-AGI economic research agenda. There's lots of questions around topics like recursive self-improvement, the ability of the models to improve themselves and unleash nonlinear growth and capabilities that need to be studied, but frankly, in the traditional frameworks of economics, are difficult to attack. And even the data available to look at some things is in question. And so my team studies these three things and looks at these questions in that regard. When I think about capability growth, we use evals, benchmarks, to measure capabilities. If many of the crowd are economists, you may not be as familiar with these evaluations, but for machine learning professionals, this is how they keep score. We have one particular evaluation called GDP-val, which is an ambitious name that I really enjoy, and it measures AI models' capabilities to do white-collar work tasks. You can think about doing a legal brief if you're a lawyer, doing a pitch deck if you're a consultant, doing a discounted cash flow analysis if you're a financial analyst. We rate the model on its ability to do those things and compare it to a human, and then have the grader, it can be a human or automatic, assess the value of both outputs. We're finding that our models can do that work at the level or better than humans more than 80% of the time. Now, that's a selected set of white-collar tasks. It's not a job, it's a task, but it does indicate dramatic capability growth. And if you think about when I joined OpenAI, that number was below 50%. I remember looking at that, and this is the biggest lesson as an economist coming into the lab. I was underestimating how significant capabilities growth was. And I think I was thinking a lot about the last mile of deployment, which is natural for an economist who's interested in institutions. I was not thinking enough of how quickly capabilities were moving up and to the right. So that's on the capability side. But OpenAI is not just a research company. We're a research and deployment company. Deployment means looking to see how those capabilities are translated into actual business use. And this is where you see a much bigger gap. And by the way, I think a lot of the disagreements about AI, the debate about AI, reflects this gap between what the models can do and how they're actually used. Most organizations, most individuals aren't using nearly, I mean, I don't know how to even quantify it, but a fraction of the capabilities that the models can do. In most organizations, you see some power users who adopt early. They use a lot of tokens. They do things with AI that no one else in the organization is doing. And you look at the median user, who's really still using AI as a chatbot, asking questions, getting a response, going about their work. That gulf between the lead user and the median user, that's the deployment gap. This is what we're facing right now in most organizations in Europe and the United States.
So I think that's clear, the enterprise adoption, and that also, I mean, in the first paper this morning, there's a lot of emphasis on organizational change,
yes,
management capability.
Yeah.
But there's also often a focus on the labor market. How do people, actual people, think about adopting or adapting to this world? So in other words, let me again maybe frame it both upside downside. So if you're trying to convey an optimistic message to people in the workforce, what are the kind of pro-AI messages you would sell? And then in terms of the issue which people fear, which is, again, this framing of maybe for some things it's just not advisable to let humans near the process. If you have a cheaper, better AI agent to do various tasks, and we can say in general, new activities will come along, new occupations will come along, but let's say you really want to be a professional economist, and then you're told, well, actually, the machines are better than you as a professional economist. So both sides, the optimistic capability issue, helping people become, avoid drudge work and have more fulfilling work, versus the fact that some occupations may just be taken over.
I think my job, I've thought about this a lot, it's not to give an optimistic or a pessimistic version. If you want to be credible as a chief economist at a place like OpenAI, you have to give a realistic point of view, a data-driven point of view. And so first, when someone comes to me about anxiety about the job market, regardless of what the data is showing, right now the data is showing in the US, unemployment rate is below 5%. I don't think in the ECB region you haven't seen, in Europe at least, AI-induced unemployment at a high level either. That doesn't make someone feel better if they're looking for a job, if they're a young graduate who's struggling to find a position. So I think for all of us, it's obvious, we should start as humans. We should use empathy first to say, look, how can I help you with this challenge? What is it about the skill set you have you can develop? What are the employers you're trying to reach? Be humans first, right? Not optimistic, pessimistic, but help people understand, because that's going to be a challenge whether the job market's good or bad. Then you use evidence, and you try to say, here are the fields that are growing empirically with the job market data we're looking at, and here are the fields that are shrinking. There was a lot of predictions about software development, for example, and those jobs shrinking as AI capabilities increased. That really hasn't happened to the same extent people were predicting. Why is that? People in San Francisco call it like Javon's paradox. It's just a downward sloping demand curve, right? When the price of something goes down, if demand is elastic, people might buy more of it. And so it's important to separate out some of the things that are being thrown around with sort of what's actually happening in the data. Healthcare jobs are increasing a ton. Now, I know here in the EU, they've talked a lot about how to make those more quality jobs, which is important, but healthcare is growing for a reason. As societies get more wealthy, they spend more on healthcare and education, and there's going to be more jobs in those areas, partly because those are very people-oriented sectors, particularly in the delivery of healthcare and education. So I think you start with empathy, you go to the evidence and try to identify what's growing and what could be shrinking. You make the point that AI isn't going to affect all jobs the same. This idea that exposure to a task is deterministic of how a job evolves in the market is incorrect. If you look at jobs as a set of tasks, you're going to miss the idea that we add more tasks all the time. We subtract tasks. My dad was an economist also. In 1985, his job was very exposed to the personal computer when he first put one in his office. But instead of using a punch card in a big room and a mainframe computer to run regressions, now he could run them on his computer. And it was a complement to his work over time, made him more productive. So just because a task is exposed to AI doesn't mean it's going to substitute for that. I think we need to think a lot harder about what jobs are, how they will evolve, and that will help us give advice to people about labor market trends, rather than being optimistic or pessimistic. This is kind of how I think about it.
So let me ask you about the evolution of the, if you like, broadly defined AI industry. So clearly, you have firms like yours which build the foundational models.
Yep.
Then you rely on a lot of semiconductor and other inputs, which are a big part of world trade at the moment. Mm-hmm. And then, of course, cloud capacity is very important, and also the energy grid, for that matter.
Yes.
And also, lots of stories about people building intertwined relationships all across that. And there are concerns about, is this going to end up as being a lot of monopoly power? But then, of course, you have open source from around the world maybe competing. Mm-hmm. Now, I know you're working for one of the big firms, so it may be difficult for you to fully answer this. But to the extent the economics group at OpenAI looks at that, what are the issues you think in terms of the evolution of the industry? And maybe on top of that, I'll ask the geographical question is, to what extent does it matter? And even without getting into geopolitics, even just economically, I mean, do we need data centers, if you like, is proximity to data centers, does that provide economic value, or is that more of a global compute resource?
Yeah.
So essentially, I know we want to live in a globalized world, but there's also geography matters as well.
So one of the things I did before I got to OpenAI was I ran the implementation of the Chips and Science Act, the creating helpful incentives for the production of semiconductors. So this was a program to incentivize semiconductor manufacturing in the United States. And it's been a bipartisan program and continued throughout administrations. And this, in many ways, reflects the first piece of the value chain in AI, even though I didn't know it to be that way at that time, which is the production of chips, both where they're manufactured and where they're designed, has a huge impact on the entire value chain for AI. And at the time, there was a lot of interest in which companies were on the frontier, the most advanced nodes, the types of things people talk about with TSMC, Samsung, Intel, and of course then NVIDIA as a major designer of those chips, working with partners like TSMC. So this all preceded AI, this kind of market structure. Then we ended up in a world where you have these foundation labs, which I'm proud to work at one. I will note, and it's very fair to call us big now, but if I would have came here in 2017 and asked you to say, there's going to be this amazing software and hardware revolution in tech, what's really going to matter is distribution, research capability, compute, would you pick among a bunch of firms today, or some two firms you've never heard of, to be leading that in 2026? I would just say, most of you would say, oh, I can name the firms, the big hyperscalers that are going to dominate that industry, and it's not going to be very competitive. So to be fair, now you have two firms, at least at the frontier, that you never heard of in 2017, right? So it is, in some ways, more competitive than many people would have thought. The last thing I'll say is upstream. If you look at the previous technology revolutions, something like enterprise software, a lot of the value was created in what they call vertical SaaS. So it's basically selling to particular industries, finance, healthcare, energy. And that enterprise software value accruing to that layer reminds us that the value chain really matters in economics. And I feel like in Europe specifically, there's a lot of value to be captured in that part of the chain, which is also can be, I mean, it's really up for grabs now, depending on which sector you're in. So I think the value chain has elements at different parts of it that are sort of more or less competitive. Some of it predates AI, but I would not take any of it for granted, because at least my own experience, if someone would have told me I was going to join OpenAI back then, I would have said, what is that?
So you just raised it just now. So I do want to turn to the issue we talked about this morning, which is innovation and adoption of AI in Europe.
Yeah.
And I mean, you must have to see the data that you can see in terms of, so maybe factually what you're seeing in terms of AI usage from your own customers across Europe. I mean, what does it correlate with? And then in terms of going back to the issue about enterprise adoption, and you said, you know, your OpenAI is partly deployment, helping firms get there, if you like.
Yes.
But again, and we always, for some reason, like to compare conditions in Europe to conditions in the US. I don't know if you want to make that comparison as well about what needs to be done to maximize the potential here.
Sure. Since I took this job, I guess I've been to Europe maybe 6 or 7 times, so I've had a chance to talk to a lot of enterprises across Europe and think a lot about the environment in the business world for adopting AI. I see a lot of interesting patterns that are different across countries. I mean, everyone in the audience knows this, but when you go back to San Francisco and people ask you after this trip, you know, what are the vibes like in Europe? You know, it's a question that requires a nuanced answer. There's so many different places, right? So if you think about, we release data on AI usage by country, and the Netherlands is number 2 on that list, right? And other countries in Europe are lower. If you look at the small, medium-sized enterprise contribution in a place like Germany, it can be very different. If you look at manufacturing versus services, Portugal versus France, very, very different. So part of this depends on which country you're looking at. The patterns I've seen is a couple of leading firms are really adopting AI in a big way, and I've seen that. You know, we work with BBVA. They've been very much at the frontier. Deutsche Telekom is another one, Orange. There's been a couple firms in each area that I've found are really kind of going full in on AI, which I found to be very interesting. I think the second thing is, this is a management and people challenge as much as it is a technological challenge. You know, when I get on a call with any executive, not just in Europe, and there's not a senior person on that call who's actually going to drive change management around AI, I immediately sort of downwardly revise my estimates of how successful this implementation is going to be. It might seem odd. Wouldn't you want the younger people, the people who are more tech savvy? You need senior leadership beyond just the CTO's office to drive technology implementation, because ultimately the firms that are getting the most out of AI are ones that are rebuilding workflows from the ground up around AI. This is not like a point SaaS, software as a service solution that you're going to drop in and expect AI to work. And so I think firms are figuring that out, both incumbent firms, but especially startup companies that are building workflows from the ground up. This is a trend I see in Europe and the United States. One thing that's interesting in Europe, I think in particular, is this last mile is probably my biggest contribution to, it's part of the weak links story. The last mile is what I think economists and social scientists bring to a technology organization. The capabilities can be immense, but if you can't solve the implementation challenges, you're not going to have the impact that you seek to have. And so that last mile has a real opportunity, I think, to be solved in Europe in some of your industrial leading companies. And so I think about big companies in Europe that have access to wide markets and capital, that are leading in their sectors. They have an opportunity to really solve that in particular areas: finance, technology, consulting, insurance. Those are some areas I think to watch. The other thing I'll say in Europe that's really interesting when I visit is robotics. If you think about what AI is today, we'll probably be talking about robotics with AI maybe in 3 years at this exact conference. And so the question then to ask is, who's most well positioned in that? And there's a lot of European players, both at the national level, of course, but at the private sector level, who can take advantage.
So let me ask you about 2 particular industries or sectors. So we still think human capital is important.
Yes.
Universities, academia, very important in helping people build human capital. But you're coming from a university, I came from a university background, and we know universities are struggling with how to deliver university education in a world of AI. So let me ask both of them together. One is that, how do you think universities should adapt to this world? And then the other type of organization are central banks.
Yep.
So of course, we're generic organizations, but we're also special organizations.
Very much.
So again, from what you see, or to the extent you've thought about it, beyond what you just said, which is, you know, you need a lead, someone who's really going to lead change in the organization. I don't know if you have recommendations for the central banking world.
Well, I'd be humble. I should be too humble then to recommend things. I can give some observations on the central bank piece. I'll start with universities really quickly. I mean, I'm a scholar of innovation and entrepreneurship. I mean, every single technological revolution in my lifetime has been powered by research that started at a university. So if you think about, and even AI, I mean, there's a lot of focus now on the research inside our labs because of the power of GPUs and the availability of GPUs to do them. You know, it's in labs, sometimes you have more power than in universities, but the fundamental AI work also came from universities, right? If you think about the early days of AI. So I think universities are going to play a tremendous role in all of this work. I think innovation in the university, our ability to translate that into commercializable technology that can be licensed, but also ventures that are spun out will continue to be important. As was mentioned on the prior panel by Torsten, you know, venture capital and startups is going to be a big part of the story. AI is a big part of that. A lot of those are coming out of universities. The one thing I'll say for universities on the pedagogy side is they have to figure out a way to work AI into what they teach students and how they assess students. As a professor, I know that's very difficult. I have to change my exams. I have to change the way I evaluate students. I have to think hard about where AI can be a complement to their learning, but not substitute, where they outsource cognitive thinking to AI. These are all big challenges that, just time permitting, I can deal with in the Q&A. That's a big challenge for universities. But universities have a pretty good track record historically about contributing to innovation, and I wouldn't bet against them here. And just on the Europe example, I have a colleague here from Munich. Last time I was in Munich, I saw an amazing deep tech cluster that is really anchored in the universities and institutions there at LMU and other places where you have quantum, you have AI work. That's something really exciting, and I think it could be a big part of the future. Central banks, there's so much work as an economist that you can do at a central bank, but also in a cross-disciplinary way. Central banks, to my knowledge, have lawyers, economists, and folks who are neither of, but very knowledgeable about both. In those situations, cross-functional work can be really facilitated well by AI. We have people on my team who don't have a PhD in economics, but they're able to participate much more in discussions in our group because of AI. Because some of the things, let's be honest, we're using Greek letters and some jargon to mask what's actually pretty simple concepts in many cases. And, that's okay. So I didn't know I'd find a good audience for that. I didn't know people would boo or cheer on that one. But to be honest, right? Like, this allows people who didn't have a ticket to the party to participate, and turns out they have good ideas. That could be true in a central bank. The second thing, and Philip, you've talked about this before, GPT as a technology has so much potential to take large, disorganized text data, like the qualitative side of things, and organize that into quantitative insights. Right. You've talked about this in your speeches. We have a product, a research project called Gabriel, which has used GPT for social science research. Our qualitative research friends, for a long time, have developed amazing data and context. But as economists, we often dismiss it. We say, oh, these are anecdotes, or we can't classify this. If I can't run a regression, I'm not interested. But now we can turn that into quantitative data, which I imagine when you're at the bank, there's so much of that going on, all these market signals. So I see tremendous opportunity at the central bank level.
I think Andre Schleifer's involved in the Gabriel work.
Yes.
And I think the phrase was, this is data for AI. So many people don't know how to code econometrics, and people use data. So having these interfaces, if you like, can be helpful.
Very much.
So maybe we've talked a certain amount. Ronnie has, given a lot there, but I think it's also time to collect comments or questions for Ronnie.
Thank you.
From the audience. So let me try and manage the time and survey it. So I'm going to go with Beata, and then Alvaro right in front of Beata, then Andrew, and then Christian. Okay.
Hey, how are you?
Thank you very much for an interesting conversation. From your experience of working with various organizations, what are prerequisites for a successful adoption of AI? You mentioned management driving the change. What else? Similarly, what are the misconceptions and factors that derail successful adoption? So what should we be watching out for if we want to do well?
Thank you. And for microphone management reasons, I go Alvaro, and actually I go to Evie after that, and then we'll move. Okay.
Thank you very much. Well, for me, my question is about the impact of AGI. So most of our estimations, whether you're pessimistic or optimistic, basically you look at the next 10 years, but we're not assuming AGI. If we get to artificial general intelligence, do you think that there'll be a significant improvement in productivity, and how do you see this playing? The second issue is also related to AGI, which is about competition. We are economists, we are always concerned about competition. Right now, as you said, no problem. But, and in fact, if you look at cloud, if you look at different plethora of systems, no problem. But in the future, again, imagine a place where somebody gets to AGI, the first mover. They will be able to absorb enormous, extraordinary rents that nobody else can. So how do you address this issue? This is a huge issue for competition authorities, also for regulators. But it would be interesting to know your perspective on the impact on competition.
Thank you. So just behind Evie there. Okay.
Thank you, Evie Papa from Carlos III. So when I heard you talking all morning here, I was thinking, we're talking here about growth in Europe when we're trying to find new models and how we can use AI. So the thing that came to my mind is bureaucracy. I think bureaucracy can preserve fairness, safety, and accountability, but it can also slow down growth substantially. So I thought that we had the possibility to use AI to kind of accelerate growth through making some tasks easier, processing applications, for example, or reducing the administrative burden. And I think also you said AI can be empathic, and I agree. You know, we can explain better to applicants why their applications have failed and try to accelerate and probably improve the red tape. But my question is, which company should the governments use to adopt AI? And this brings me to a second question, which is I've noticed that many firms do not adopt AI, even the universities, all of us academic professors, we use ChatGPT or Codex or Claude, but the university doesn't have a license. We do that individually. So I would like to understand from your point of view why this is the case.
All right, great. Should I take these three?
Yeah, I think probably okay. We would do that.
Okay, I'll try to be quick, and this is good. This is NBER style, where you get 3 questions and you ignore the one that you can't answer and you take the other 2. Now, I'll try my best to answer all these excellent questions. Okay, prerequisites for a successful implementation. I'll refer you to, we wrote an article for managers in Harvard Business Review. Some of my work on my team is academic articles we send to econ journals. Other things are short reports, like our recent report on AI and jobs in Europe, which came out yesterday. And others are sort of for practitioners in places like Harvard Business Review. We talk about a micro-productivity trap, which is what I really see with a lot of companies. And just to summarize quickly, a lot of companies are running pilots, small-scale experiments around AI. If you design a pilot for an outcome that nobody cares about, and it's underpowered, and you can't show the next person who picks it up that they should continue it, your pilot dies on the vine. So many managers are designing AI pilots, often sort of in the technology area, with the hope that they'll scale, and they're failing. And so companies are littered with pilots that are just done. The key issue is to pick something you can actually measure and that matters to the organization. People come to me and say, how should I measure value of AI? I say it depends on your industry. What are you trying to maximize? What is your objective function? So you need to design sort of pilots that are powered enough to develop results on outcomes of interest that can then get picked up by someone in the business function who will then scale it. Most people are not thinking about pilots like that in AI. I also think that many people are thinking about AI as a panacea rather than the beginning of a conversation about how to change the way their organization works. And if you neglect the human element of change management, which we teach in business schools, you're not going to be very successful in your AI implementation. So that article details some of these ways to overcome this micro-productivity trap where you're measuring things that don't matter in an underpowered way. Second, on AGI, I mean, Torsten put up some great charts on this, and it made me think a lot about sort of the growth outlook and whether we're incorporating some of the ideas around AGI. I think one is the research on weak links in sort of the process of how sort of growth occurs is really, really important. We could have amazing intelligence, super capable intelligence. I would argue even today it's super capable. But if you think about drug discovery as one example, a big piece of the GDP growth comes through accelerating innovation, okay? Innovation also involves humans. It also involves handoff. It involves clinical and regulatory guidelines. In healthcare, you have to run clinical trials in the end of the day with humans. And so at the end of the day for innovation, you might have an enormous number of ideas that are just bottlenecked by testing. And so I think actually while it's important to think about building sort of AGI, that's the most important thing, trying to solve those weak links is also really important, which is why I think it may not work out exactly at the pace that you're talking about in terms of affecting GDP. I do think, though, if you think about recursive self-improvement and its ability to sort of concentrate the gains, we do need to think about, I mean, the social contract, competition policy, all these things in a new way, because this is important, whether it's in the near future or further out. So I'm with you on that. I see a lot more work to get to that. On bureaucracy, I guess the only thing I'll say is when I was a student, there was a big focus on the internet being rolled out and allowing people to get access to information they didn't have before. We all remember this. And the idea was something, if you can get people more information, a generation of economists did these experiments on provision of information. If I give people information on the wage of their job or how likely they are to get to move to a better neighborhood and affect their wage, then they're going to make decisions that are in their economic interest. Now we're moving from provision of information to provision of agency, the ability to actually use AI to navigate bureaucracies. And so what I'm kind of excited to see in a lot of countries that are sort of subject to considerable bureaucracy, can AI actually help people cut through red tape? You think about the process for getting off a private school waiting list in some emerging markets where the school has slots, but it's not visible to the applicant, or there might be reasons that they're blocked off from that. Imagine if the agent is working on one side with an agent on the other side, that you could set up the rails to make that work. All of a sudden, the allocation process on something like that could change. And so I'm wondering actually if AI can be a navigation tool to reduce bureaucracy. That's my hope in terms of how we think about this. But it's going to have to be embedded in the institutions, and they're going to have to adopt it, hence your point about universities and individual use.
Very good. Andrew?
This is fascinating. Can I put to you something that's been put to me by others in the industry? You may disagree with this, and this is fine, but it leads to a very big question. And it's this, that in the foreseeable future, there isn't enough clean power supply. And by clean, I mean technically clean. It's not a green point, it's a technical quality point, to create enough data center capacity to do all the things that AI could do. And so there are then some very big choices. You know, if you think about all the things that medical science could do, all the things, you know, drone technology could do, our world could do, entertainment could do. And, you know, we live in a world where we've essentially expect the market to make those to resolve those choices. But those are, you know, there's a very big social interest and public interest question in there. So I'd really be interested in, at OpenAI, how you think about that question. This is, you know, this is a question that confronts you, as it were, as a company, but has a huge public interest element to it.
Thank you. I mean, you can just pass it back to Austin Goolsby, the mic.
Yeah, thanks. Ronnie, it's great to see that these firms are hiring top economists and trying to think through these issues. Thank you. We started with Phil saying, hey, what are the limits that slow down adoption? And we kind of have mostly steered into the realm of the only limit is our imagination. And I think this previous question raises this issue of there might be some of the more grubby macro IO kind of limits that I'd be curious at what you think through. Yeah. One style should we expect this rate of improvement that we've seen in AI if compute, electricity, environmental costs, size of the data sets, all of those become barriers? There are clearly diminishing returns on those. So should we expect that the rate of improvement of the AI models will slow significantly? The other style is maybe the cautionary tale of the telecom companies in the United States, where there were a small number. They went to 3G to 4G to 5G. They were major technological improvements, major capital expenditures, but the competitive nature of this, that they were investing to steal market share from one another, you could make the argument that they overinvested, and you could make the argument it didn't justify huge valuations for those companies. Most of the benefits ended up going to the users. Do you feel like either of those dynamics are relevant?
Thank you. Maybe also you can pass it forward to Silvana and Boris, and then we can answer those questions. So.
Thank you for that presentation. Is there any aspect of AI that worries you and should worry central banks and societies?
Very good, yeah. Okay, I'll start
with... Well, we'll just take Boris and then back to you.
Sorry,
yeah. Just a very simple banker's question. Do you think the AI investment development is more inflationary or disinflationary? Do you think that... It looks a little bit like in a short run, at least, quite obvious that it's inflationary. If you look at the Apple's prices going up because of the lack of the chips, and then the fragmentation where you cannot buy from cheaper producers, so you have a fragmentation with that. So it looks inflationary short term. But long run, if the productivity really picks up a lot, but then it depends on the impact of the labor market, whether you displace people, and then the aggregate demand comes down, because of the consumption and the government revenues also. So we have to completely reinvent the fiscal policy and the whole monetary policy mix. And we also might aim for a different target then as a central bank. So
Gotcha.
what do you think about that?
Thank you, Boris.
Gotcha. Excellent.
Thank you,
Wow.
Ronnie.
4 easy questions. This is like a day in the park, Let me start actually with the hardest one, but it's the one I think a lot about, which is what about AI worries you the most? I get asked about this a lot because I work at OpenAI and I believe in the technology in terms of the capabilities and what it can do, but I tend to think about some things separate from economics, but I think they still should affect central bankers and how you think about it. And the primary area is on young people and education. I worry a lot about how we're going to introduce AI into schools and what the best way to do that is. So when I fly from North Carolina to San Francisco each week for my job, I talk to ChatGPT every part of the way. And I talk to it about economics. I talk to it about a talk like this, and I say, well, hey, I have these really big ideas on AI and inflation, but what if someone asks me a really complicated question about it? How should I answer? Now, I have to know enough about the topics I'm asking about to really get the most out of it. But what I get out of it, and it talks back to me, is amazing. I couldn't have imagined. I would have literally felt like if you told me that 3 years ago, I'd be living in the future. So I feel for me, AI is a complement to my expertise in a huge way when it comes to the research I'm doing in economics, identifying new questions. But my daughter hasn't taken economics yet. She's 13 years old. And so for her, could she use it the same way? And would she, she's really not using AI in this way right now, but would it be tempting to use it to outsource sort of the cognitive process, the learning of economics, the hard work? Everyone here, when you studied economics, you had to draw those curves so many times, do those equations so many times. I remember copying over my notes before midterms to make sure that I really understood what would happen if someone changed a variable or changed an assumption. What happens to that in a world where essentially, AI can do that for you? And as much as we design pedagogy around it, are we going to be able to limit, and speaking as a parent who has a lot of trouble regulating screen time, how are you going to do that with access to AI tools for students? And what does that mean for the kind of education that they're going to gain? For me, so much of the magic that I get out of AI is because I already love learning. And if I don't have that's very difficult. And it might not be about my daughter, but a whole generation of kids. So that's something I think a lot about. We have an EDU team that is working with schools. I'm trying to do as much research as I can in that area to figure out if people are really doing that cognitive offloading, under what conditions, and how to make it better. This is definitely what I'm most worried about. Actually, much more than many of the topics we've talked about, just because I feel like I'm seeing it in real time. That's one. On the power supply question, I think Pascal Restrepo has a great paper on this, which basically is a model showing, basically what would happen if compute was the only constraint. And compute sort of equals power. And I think it's really interesting to think what would happen in that case. I think what we think about at OpenAI is a version of that problem, which is how to allocate compute. The question now isn't like, how can I solve a problem? It's, should I solve that problem? It's a whole different question. And I think inside OpenAI, it's a question of what are the problems that are most important to solve. And I think as a society, and this is illustrated, at least the way I read Pascal's paper, in terms of how you allocate compute across a bunch of sort of use cases. And there's going to be things that AI might be better than humans, but we're not going to use AI for it because we're allocating to other things like drug discovery or designing semiconductors. That, to me, super interesting point from his paper, also like a real-life challenge, and I think that's what we'll face if power is a constraining factor. I don't know enough about the technical point that was brought up to know if it's a technical limitation. I certainly think the big investments in infrastructure, and this goes to Austin's question and others, are trying to make sure that compute isn't as much of a constraint. So that's how I think about that one. On Austin's question, and I worked for Austin for a long time, so I thought that would buy me an easy question, but of course, your mentors always ask you the hardest questions, but it's a good one. And I think when I think about those other constraints, he's right. I sort of think about the frictions being inside organizations, bureaucracy, change management. This is kind of reflecting my training. But when you think about sort of the macro constraints, it's really, do you believe in scaling laws? The idea if we have bigger models, more data, sort of, we can have more compute, that the models will get smarter and smarter. If scaling laws are true, but we don't have enough compute to power them, at what case do you basically see some bottleneck on intelligence? This is kind of what we're talking about. I think right now, there seems to be tremendous demand for the intelligence we're producing. So if that continues and supply doesn't keep up, I do think there'll be constraints on that. That's why OpenAI has made a big bet on hardware and infrastructure. I remember when I joined OpenAI, there was this big debate, and this was 2 years ago, about oh, we've overinvested in compute, or we put too much into hardware because look at all these models from other parts of the world that are going to do everything that OpenAI does. It hasn't happened like that exactly, right? Do you remember that debate? It basically dominated the media for about a month and then went away for a little bit. And I think what's interesting is month to month, there'll be different storylines, but for OpenAI at least, there's been this conviction, and we'll see how it turns out, that building the infrastructure, building the compute is the key thing to harnessing intelligence and getting to AGI. So that's what we're doing. I think to the extent that we can do that more quickly, we'll solve some of the issues that we're talking about, but there are lots of bottlenecks in the US, for example, around permitting, around interconnection, and even just generating the energy in and of itself. And then inflationary, deflationary, I mean, let's see how it goes in the long term. A lot of people are thinking that AI will have sort of a deflationary effect in the long term. I do think your point about aggregate demand and how the impact of labor is going to be sort of dispositive here. So let's see how this works. Right now, you do see it. I mean, Philip and I talked about this in our pre-call. In the PCE, you see some increases that's probably driven more by the hardware side than, let's say, AI itself. That'll be something to watch going forward, but I don't yet know how that's going to turn out.
Very good. So I'm going to turn to President Lagarde. It's coming. Yeah.
Thank you. Well, thank you so much to the two of you for making such a fascinating discussion. I'm going to ask you a lawyer's question, an economist. Okay. So if you steal my money, you are liable, and I'm going to sue you, right? So if an AI agent designed and developed by OpenAI does the same thing because of recursive improvement, because he's a liar, because he covers up, who's liable? The designer, the developer, the brand owner? How do you cover corporate liability at OpenAI at the moment?
Well, I think, to me, if I'm understanding the question right, it's not going to be a company-by-company decision. I mean, it's building a legal framework to address this. Just so I'm thinking about it right, when I think about the rules of the road that governed the last big innovations that affected, let's just say finance for now, right? Credit card companies, right? When someone steals your card or steals your number and they charge it, typically for the company, they give you that money back, right? That hasn't always been the case. It took a bunch of policy innovations and corporate decisions and institutional norms to develop around that. And I believe that some of the companies that are positioned in that area are going to now apply this to the agent world as well. So I feel like we'll be building on some of these things we've had before. But I doubt it'll be, and I don't think it was in that case, one company that decided. It shouldn't be. It should be an institutional decision to figure out how to think about those things. To my knowledge, that hasn't been decided around the world. But to me, like, with the integrity of markets and exchange, we need to get that right. So I haven't studied this, but this is my sense. Yeah.
Very good. Now, we have a minute. So I'm afraid I'm going to have to pick and choose. And essentially, I'm going to rotate back to this side of the room. And I'll ask Laura and Helen to ask their questions. And then that's it.
OK. I'll try and give a quick answer. Thank you, Laura and Helen, for being patient. Hey.
Thank you very much. This has been fantastic.
Thank you.
So I think we would all agree that the US and China are leading AI, different models. We have been discussing the role of Europe, whether it can get in or not. But what are your views about the rest of the world, and in particular, the developing world?
Excellent. OK. Good.
So what is the probability that you put that there's going to be another generation of AI model, which is very different from a paradigm point of view from the current generation of LLM? So in particular, Yann Lequin has been talking about these things, one. And second, what do you think about Daron Acemoglu, that we can actually direct technological change? Does it actually apply at all in your field, or do you think it's completely wishful thinking?
Amazing. OK, I'll answer these, and then we'll. OK, on emerging markets, I can talk about the places I've been, and I'll try not to overstate my expertise. I went to India for the AI summit, and obviously, given my background, have spent a lot of time there in my life. The Indians are eagerly adopting AI. There's a lot more optimism, I'd say, among young folks on average that I talked to there about how they can use AI. Partly influenced, I think, by their previous generations of technology and development and positive experiences, at least as it relates to economic growth. There is a question, if you look at like the Indian equity markets, they're much more concentrated in like technology service companies rather than companies in the AI supply chain. Let's say contrasted with Korea or Japan, where there's a heavy mix on semiconductor and supply chain for AI companies. So I think in India, a lot of optimism on the technology side. It'll be interesting to see how local firms adapt. I also think in India, they have a very dynamic sort of education sector that's producing a lot of engineers, and that's something they're really interested in, whether I think it might be 1 million engineers that graduate every year, what kinds of jobs they'll do. So a lot of attention on the early career for engineering, but in general, a lot of optimism about sort of AI in India, which was interesting to me and probably reflective of the history. In Brazil, where I've been recently, I think a lot of interest in how AI is going to be used in key sectors for Brazilian economic development, like agribusiness, and so we talked a lot about that. More interest than in other countries about how it's going to affect things like disinformation and the provision of information in the media given recent events. So I thought that was interesting. Indonesia, just sort of starting to think about a lot of these issues around infrastructure and data centers. There's been a huge amount of data centers being built in Malaysia. So in Southeast Asia, a lot of connections around the infrastructure piece and the role they'll play. Also, somewhat like India, a massive amount of young people graduating each year. I mean, if those of you who haven't been, the University of Jakarta was like one of the most amazing experiences I've had, because you have the sense sometimes when you're sitting somewhere else that, you know, the conversation is going to be very different. But sitting there and having the students telling me about how they're using agentic AI and it matching what I'm hearing in San Francisco, it just really makes it clear what we're living through. And people are living through it at the same time, which is quite interesting. Last, in the UAE, another part of the world, super interested in how to play in a more substantive way on the technology side of this. As you know, like the Gulf states have traditionally provided lots of financing for technological revolutions. They're more interested as well in how to build local talent. So you see amazing innovation on the university side, building entire universities around AI. That to me is something really interesting to watch in the Emirates and other places. Helene's question, I think it's super interesting to think about whether there might be alternatives to LLMs. For OpenAI and the things we've talked about, LLMs have still produced a lot of sort of benefits, and so we're continuing to work on those. I will say, just so people are thinking about it in the way at least that I think we should, we've already lived through like 3 different revolutions when it comes to the LLM in this conversation. We started with chatbots, right? The way you experienced ChatGPT in 2022. We moved to reasoning models. The O1 series pioneered at OpenAI as well, which was really taking advantage of the inference piece, right? Which again, as we think about the constraints on compute, we shouldn't forget there's lots of innovations in other parts of the stack, including inference, that made models smarter. And now we're in an agentic world where you can delegate to a coworker and the agent can go do the work. Those are 3 different things that have already happened off of the LLM infrastructure. And so I think there's probably more acts to that play that we might see. But I mean, the story of innovation, why we're in the position we're in today, is because venture capital and other sort of risk capital is willing to invest in alternative ways of doing things. That's a good thing. And that means that these other models and alternative approaches are going to have a chance to shine as well. And I look forward to seeing what they do.
So this has been quite an intense 45 minutes or 50 minutes nearly. I look forward to reading the AI-generated transcript and slowing down, because actually, I think every sentence Ronnie said, there's a lot of content in there. But of course, there's been a lot in 45 minutes. So round 2, when you read the traditional text, will be also, I think, add a lot of value. So let me thank Ronnie for his really great contribution. And I'll hand back to Claire.
Thank you so much. I appreciate it.
Well, thank you both for such a fine end to day 1. I'd now like you to all go downstairs. We're going to take a group photo, and then we'll be meeting for dinner at the hotel at 7:30 p.m. Look forward to welcoming you back to day 2. Thank you.